The markets finally seem resigned to listen to what central bankers have been telling them all along. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking you off to the closing bell here in the U.S. The everything rally we saw in late 2023 has given way to risk-off in mid-January as Fed Governor Chris Waller's comments continue to reverberate across financial markets. You're looking at the S&P 500 accelerate its losses in this afternoon. 2 days of trading this week, 2 days of losses. And, of course, the two-year yield is more sensitive to Fed policy. Price down, yield up. The two-year moving up 14 basis points to 4.36%. The dollar continues to strengthen. The Bloomberg Dollar Index is actually up for a fourth straight day, gaining against all the major currencies except for the British pound. Stronger dollar tends to mean lower commodity prices. You're seeing crude oil in the red, although it's come off its lows. We do have tensions continuing to swirl in the Middle East, but really it's that stronger dollar that a lot of this is reacting to. Romaine?
All right, well, let's go back to the dollar. Let's go back to stocks. Let's go back to bonds because the latest batch of economic data is really driving stocks and bond prices lower on the day. Those U.S. retail sales numbers increasing 0.6% in December. That was twice the rate that we saw in November and well above economists' predictions. 9 of the 13 retail categories up. The biggest gains, clothing and department stores and auto sales, they were up 1.1%. And that caps a year of surprisingly strong household spending for 2023, strength that raises a lot of questions about the fight against inflation here in 2024. Now, you take those retail sales numbers and you combine them with that surprise reacceleration of inflation over in the UK, and that is helping to push short-term U.S. Treasury yields higher by the most since June. Remember, for days now, officials from the European Central Bank and the Fed have tried to tell the market to temper expectations for policy easing. Yesterday, it was Fed Governor Chris Waller. Today, ECB President Christine Lagarde sitting down at Bloomberg House at the Davos Forum in Switzerland. Lagarde said she fears the fight against inflation could be hampered if the market's bets for rate cuts are too high compared with what's likely to actually happen. Her words. Well, guess what, Scarlett? Some traders are now paying heed to that. Markets here in the U.S. right now pricing in 140 basis points of rate cuts this year. That sounds like a lot, but that's actually lower, a full quarter point lower than where we were just about a week and a half ago.
All right, so let's show you what that actually looks like. Following Chris Waller's comments and, of course, the latest retail sales report you were just telling us about, that works out to about 5.5 standard rate cuts, where each reduction is about 25 basis points or 0.25%. Romaine, as you mentioned, that is less dovish than last Friday when the market was pricing in 6.7 cuts. Remember, the Fed itself, in its latest summary of economic projections, is penciling in only 3 cuts. And just as important as how much the Fed will cut rates by and starting when is why the Fed would be compelled to start easing policy. And that part, of course, Romaine, is data dependent.
All right, well, let's get some insights out of our next guest. Marilyn Watson joining us right now to help us kick off to the close. She's head of global fundamental fixed income strategy over at the behemoth BlackRock. Marilyn, great to have you here on the program. Let's put your expertise to the test here because I think everybody is really looking at these various economic data points, and it continues to paint a picture that I guess is good for the economy to a certain extent. But if you are betting on, as Scarlett said, 6.7 rate hikes, then I don't necessarily know that data is supportive of that.
No, I think you're right. Certainly think that the recent data is not supportive of maybe rate cuts coming into effect as the market had been pricing for March. Now I think the market is less than 50% probability of that. And given where inflation is, given the still resilient economy that we're seeing, we still have a pretty tight labor market, even if it's cooling a little bit. And I just don't think the data is there yet for the Fed to be comfortable in cutting rates in the short term. And I think that's what many of the different Fed speakers have been trying to tell us. So I think, obviously the timing of when the Fed may cut rates for the first time is the hot topic of debate across the markets. And I think it's likely to be a bit later in the year than March.
Well, this gets to a question here about market positioning, and it also gets to a question here about whether we're going to see a repeat of some of the volatility in the rates market that we saw in 2023. If that's the case, where do you go? And maybe this is an oxymoronic question, but where do you go in the fixed income world that doesn't leave you significantly exposed to interest rate volatility?
Well, so we have seen a fair amount of volatility. I think what we saw last year and also this year as well is in many ways just an effect of the fact that we had suppression in yields in fixed income markets overall for many years from the central bank policy. So there was no dispersion between the price of individual bonds. It was very, very hard to get at the underlying fundamentals of that. Given the repricing that we've seen over the past 18 months or more, we can now get actually at the underlying fundamentals of different individual bonds. So I think now you can actually benefit from some of the volatility that we've seen. You can, I think, given the all-in yields as well, still get very attractive carry in areas, the investment grade market, even in the belly of the US Treasury curve. A little bit in areas of high yield. Obviously, an all-in yield of 8% or so is attractive as long as you're very, very aware of the risk reward, what you're buying. And we actually like a very diversified range of opportunities globally. So also in securitized, in investment grade, and in the different regions around the world. So I think now we do actually see a far greater opportunity set for not only earning the carry and the yield that investors are looking for, but also for that price appreciation when you really understand the fundamentals of the underlying bonds.
We mentioned the dollar strength earlier, the Bloomberg Dollar Index gaining for a fourth straight day, gaining versus all the major currencies except for the pound. How does that affect the attractiveness of US dollar denominated fixed income?
So if you're for foreign investors, if they're looking to invest in US fixed income, given the levels where yields are, given the carry, it still looks pretty attractive when hedged back from many different currencies. So I think it's still attractive, but it does depend. But conversely, if you're a dollar investor and you're looking to invest in broad, then if you to invest in Europe, for example, hedging back, you get a very, very nice pickup back into dollars. So it really depends on the region where you're investing and then on the overall price and yield as well. But I think given these moves and given where yields are now, then overall US fixed income does look pretty attractive on an overall yield level.
What about on the corporate side? We've seen a lot of the banks start selling bonds, especially the big banks that just finished reporting earnings. How much demand do you see for that kind of debt?
Well, we're continuing to see demand, and the supply there's been pretty good uptake so far, and I think we are seeing flows going more and more back into fixed income that were either sitting on the sidelines in cash, maybe that was in money markets. But now, as investors do need to look for different sources of income, they do need to match liabilities that they have in their portfolios elsewhere, then we are continuing to see demand, and I think we'll continue to see that going forward. We have seen a lot of supply this year in the US and in Europe and elsewhere. We expect that to continue, but for the time being, demand is there among investors to really capture the yields as we currently see them, particularly if you do expect eventually rates will come down in the US, in Europe and elsewhere. Then the ability to lock in some of these rates at very attractive levels still, I think, is advantageous for many investors.
All right, Marilyn, great stuff. Always great to catch up with you. Marilyn Watson, head of global fundamental fixed income strategy at BlackRock, helping us kick off to the close here on this Wednesday afternoon. Coming up here on the big program, a closer look at some of the bank results as they continue to roll on. Results out over at Citizens, U.S. Bancorp, and Schwab. We're going to break down those numbers with Gerard Cassidy at RBC Capital.
Plus, Boeing shares are on the move to the upside after operators completed inspections on an initial batch of 40 planes. That's a key step to eventually ending the grounding of the aircraft as ordered by U.S. regulators.
And changing climate conditions threatening the future of one of the biggest marvels that we've had over the past century, the Panama Canal. We're going to talk to two experts for their insight into what's going on down there. We're going to go out to Lake Gatun to the Smithsonian Tropical Research Institute. All that and more coming up in just a bit. This is The Close on Bloomberg.
This week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As markets anticipate a dovish pivot by central banks, policymakers grapple with two wars on the global stage, and AI continues to dominate the tech headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Continuing coverage this week, only on Bloomberg Television and Radio.
All right, we had strong U.S. economic data out this morning with U.S. retail sales rising the most in 3 months and homebuilder sentiment increasing the most in almost a year. Bloomberg's Matt Boesler joins us with what this means at large for Fed policy. But before we break down those reports, we also got the Fed Beige Book report, which of course is like anecdotal summaries of what's been going on across the Fed's 12 districts. Wrap that into what that looks like when you take stock of that with the retail sales numbers.
Yeah, so the anecdotes in the Beige Book are suggesting that even while overall economic activity was roughly flat or unchanged, a lot of the weakness that you're seeing there is in manufacturing, whereas on the consumer side, things are still bustling. So the Beige Book talks about strong holiday spending, which is something we saw in today's retail sales report. It also says several districts noted increased leisure travel, and a tourism contact described New York City as bustling. So, again, it's just consistent with this kind of two-track economy where we're seeing weakness on the industrial side, but the consumer so far is not showing many signs of slowing down.
This gets to the question as to whether that momentum actually continued or is going to continue in 2024. I mean, there were a lot of naysayers towards the end of the year saying that any strength you see in those December numbers, even for those November numbers, was probably something that would fade pretty quickly.
Yeah, and so I think, again, that's a huge question mark heading into the new year. But at the same time, these forecasters have been calling for this slowdown for, the better part of a year now, and we just haven't seen that happen. So I think there's a little bit of concern about, are the assumptions that we've been making still valid? Are the models still working the way that we think they should be working? And so I think you need to maybe discount that a little bit on the other side, too.
Mm-hmm.
For all the talk about how many rate cuts we'll get and when they start, what's going to be the particular catalyst for anyone who's still counting on the Fed to cut rates by six different times by 25 basis points each time? They're basically counting on a hard landing, a recession, aren't they?
Well, there are two ways to look at it, right? So that's definitely one interpretation, and that's consistent with what we're seeing in markets today, right? We had strong retail sales, and traders are paring back those bets on interest rate cuts a little bit. But on the other hand, we've seen inflation coming down really fast over the last several months, and so that kind of speaks to the pace of rate cuts versus, when they start and how aggressively they go. And so if inflation keeps coming down as quickly as it has, that will be a reason on its own to reduce rates in 2024, despite what's going on the consumer spending and real economic activity side.
All right, Matt Boesler helps lead our economics coverage here. And on that point, I don't think there's any debate here that most folks expect rates to be lower at some point this year than where they were last year. The question is by how much and when those rate cuts start. ECB President Christine Lagarde, she had a chance to sit down with us over at Bloomberg House out in Davos, Switzerland, and signaled that her central bank may cut interest rates at some point in the summer. Let's take a listen.
I'm confident that short of another major shock, we have reached a peak, okay? Now, we have to stay restrictive for as long as necessary to make sure that we get to that state where we are all saying, okay, confident that it is at 2% medium term. I know some people argue that maybe we are overshooting, maybe we're taking risks. I think the risk would be worse if we went too fast and had to come back to more tightening, because we would have wasted all the efforts that everybody has put in the last 15 months.
But this would be, again, economically or also the trust in central banks? If you get this wrong, does it hurt the credibility?
Credibility matters, let's face it. When we say we will get to 2% medium term and this will happen in the medium term as we define it, if people believe in that, and they should, because we will do it, it matters. It is a component in the sort of chemistry that determines inflation going forward.
And again, so the timing is quite fluid, but there seems to be a majority on the Governing Council that expected probably by the summer, if not in the summer. And you've talked to some of them, they have spoken recently, and each of them has their view, which I respect completely. We generally coalesce towards the decisions that we make on the basis of data. Some of them have their local domestic data. They have their respective inflation rates, which are different from one country to the other in the euro area. Where, if you look at Portugal, if you look at Germany, it's going to be different, obviously. But it's their job to say, well, it's likely that. I would say it's likely too, but I have to be reserved because we are also saying that we are data dependent and that there is still a level of uncertainty and some indicators that are not anchored
at the level where we would like to see them.
The U.S. election.
Yeah, let me have some coffee.
How worried are you about the U.S. election?
It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. But this is what they should be considering. And of course, we cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation.
A very diplomatic ECB President Christine Lagarde at Bloomberg House in Davos, especially when she answered Francine's questions about the U.S. election. Let me have a cup of coffee first, and then a long pause before answering.
Yeah, well, if that's how she feels, how do you think American people feel right now? Yeah, she was definitely very diplomatic about that. And as, of course, Europe learned during the last election cycle, you know, the results are the results, and you're going to have to learn to deal with whoever is our leader one way or the other, whether that makes your job harder or not. I do want to go back, though, to the discussion about rate cuts, because I do think it's interesting that she seems to be making it the case that they will have the wiggle room to do that this year. But is it going to happen as soon as the market wanted? Like we were talking earlier about how rate cuts are being the expectations for how many rate cuts we're going to be tempered, but they're also pushing those back. Remember, everybody thought March was a lock here in the U.S., that March meeting, I think just last week it was something like 90% chance that we were going to get a rate cut there. Now that's basically 50% here. Yeah. So it gets to the question here, not so much whether they will, but how late in the year should we expect to see that first one come? And
she mentioned the data, how they're going to be data dependent. The data show right now, CPI coming in exactly as economists had anticipated, 2.9% increase year over year on a month over month basis, 0.2%. So they're looking for that 2% target.
Yeah, absolutely. Do you think that was really coffee, or she was just using that as an excuse?
Ooh, good question. I have faith that it was coffee. All right, we've got much more coming up on the close. Regional banks reporting earnings earlier today. We'll recap those results and look ahead as more of them report throughout the week. What is the story there? This is the close on Bloomberg.
All right, welcome back. We've heard from the big U.S. banks, but now it's time for the regionals to have their moment. Citizens Financial and U.S. Bancorp, just some of the banks out with fourth quarter results today, both beating street expectations, though, as you can see, the shares going in opposite directions. Gerard Cassidy joining us right now to help break things down, head of U.S. Bank Equity Strategy over at RBC Capital Markets. Gerard, great to have you on the program. Let's start with U.S. Bancorp here. Those shares are moving lower, despite what appeared to be a pretty solid beat on most of the key metrics here. Why do you think investors aren't as enthused about the report?
Romaine, I think what you're seeing here with U.S. Bancorp is that when you take a look at the net interest income growth for 2024, they gave us some guidance, and it was, I think, a little less than expected. One of the highlights, however, is that U.S. Bancorp has very strong capital levels. And you might remember in 2023, there was a concern that they weren't going to be able to reach certain capital levels because of the acquisition of Union Bank and their unrealized bond losses in their available for sale portfolio. And that has not proved to be the case. They've been very good at optimizing the balance sheet, managing the capital levels. And I think what we're going to see is that once we get the final rules for the Basel III endgame, which talks about capital levels for the large regional banks and the money centers, U.S. Bancorp can get back to buying back their stock like they have in the past.
Well, actually, I'm glad you went there here. So let's talk about it. I mean, there were some interesting comments by Michelle Bowman at the Fed, who, of course, has been kind of one of the main roadblocks to getting this done. She basically wants to see a slightly better framework than what was originally put on the table. But her recent comments over the last 24 hours seem to suggest that they still got a long way to go there over at the Fed to figure something out.
Romaine, you're absolutely right. I mean, when you look at her comments, there's talk about having to redo the whole thing and have another comment period, which was really, I thought, new news today. The comments, all the big banks had to submit their comments on the Basel III Endgame proposal by yesterday, and obviously they did. But as we go forward, there's many constituents that are lining up against what they have proposed, and they may have to go back to the drawing board. But bottom line, Rumi, there will be higher capital requirements, there will be lower profitability, but just not as severe, I don't believe, as what they initially proposed.
Right. It is a little bit of a moving target, but it is coming. I just can't help but remember that it's been almost a year since the regional bank crisis. And last year at this time, when banks were reporting, no one really had a sense that that was coming. If rates end up staying higher for longer, they don't get cut as many expect. Which regional banks are set to feel the mismatch of assets and liabilities the most?
I think, Scarlett, what you're going to see is the banks are going to do well in a higher for longer short-term rate environment, because history has shown when the Fed has reached its terminal rate for Fed funds, and that's what I'm suggesting when you say higher for longer, they're not going to raise short-term interest rates. But what happens, and U.S. Bancorp touched on this a few times in their earnings call, the deposit costs, the funding costs for banks start to stabilize, generally around 6 to 9 months after the last Fed funds rate increase. And that was in July. So what you're going to see is that as the funding costs stabilize, the cash flows coming off of the asset side of the balance sheet from bonds and loans get reinvested at higher yields. All of a sudden, the margins expand. So I think what you're going to see is a real benefit to the banks if the Fed doesn't cut rates until the third or fourth quarter of this year.
All right, good to know. And looking at the KBW Bank Index, so far this year, the index is down about 4.3%, and all 23 of the 24 members are lower. The exception is Bank of New York Mellon, which is up about 5.3%. What's the source of that strength, and does it continue, Gerard?
Bank of New York Mellon, as you probably know, along with State Street and Northern Trust, are our custody banks. And Bank of New York Mellon, under Robin's leadership, has really done a very good job in slowing or bending the curve on costs. Mellon's always had an issue with that. But at the same time, what you're seeing is that the custody banks, they are very liability sensitive. And what I mean by that is when rates go higher, they have to pass that on to their depositors, because their depositors are large financial institutions, and they're not grandma and grandpa accounts like Bank America or Fifth Third has.
Yeah.
So as a result, the rates have gone up. So now if you really do believe the Fed's going to cut, this is one of the banks that will benefit along with State Street, because they're going to cut their funding costs immediately since they have very high deposit betas.
All right, Gerard, always great to catch up with you. Gerard Cassidy over at RBC Capital Markets, a breakdown of some of the bank earnings that we've gotten now, deeper into the regionals. It'll be interesting to see what happens over the next few days. We'll have full coverage of that when it happens, but stick with us here on The Close, right here on Bloomberg. This is the countdown to the close. Keeping an eye right now on what's been going on in the equity market. We remain on the back foot for yet another day. Similar story when it comes to treasuries on a pricing basis. But let's check in now, Scarlett, with what's going on in commodities with our commodities close.
Yeah, stocks and bonds are in the red. Oil was as well. But in the last 10 minutes or so, it's actually flipped into the green. Down as much as 2.6% to $70.50 a barrel, but has now again turned positive, $72.53. European natural gas, however, extending its declines to a third day. It's now at a fresh 5-month low. There are signs that the region is well supplied for the rest of winter. We know that Europe built up record gas reserves last year. And because of the slower than expected sluggish economy, it has been pretty slow to draw them down. I also included Chinese iron ore. So we're going global today. It's down for an 8th day in 10 as data show that China's steel output slumped 15% in December. And you could see gold there losing more than 1% right now as the readjusting of pricing Fed rate cuts this year is hitting gold as well. It's still holding above $2,000, but it did fall below its 50-day moving average, its short-term trend line, for a second time in as many weeks.
All right. Well, of course, taking all those commodities, you have to get them around the globe. And as of late, that's been a relatively difficult task. Whether you're trying to go through the Suez Canal or the Panama Canal here in North America, you're running into a lot of problems. The Panama Canal moves roughly $270 billion worth of cargo annually. It's a trade route taken by at least 40% of all U.S. container traffic coming from Asia alone. But that crucial waterway has been contending with the drop in water levels so low that the Canal Authority has been restricting the number of ships that pass through it each day. So who better to talk to than the folks over at the Smithsonian Tropical Research Institute? They track the climate issues affecting that area, and I'm pleased to say that the director of that institute, Joshua Tewksbury, joins us right now, as does researcher Stephen Patton. Great to have both of you here on the program for a topic that has really enraptured a lot of us. And I want to start with you, Stephen, particularly when it comes to the water levels. You go back a few months ago when I think we saw what at the time we know to be sort of the record low levels here. Where do we stand right now with water levels, particularly relative to where they should be?
Right now, the Panama Canal, primarily Lake Gatun, which is the primary part of the canal where the ships are crossing, is about 3 feet below where it should be at this time. And because we've now entered into our dry season, that lake level is going to drop probably another 2 to 3 feet before the rains begin again in May.
I am curious, Joshua, about kind of the lack of foresight, and it's understandable for something that I guess we're like 110 years old right now in the Panama Canal. I'm sure the folks who were building that back in those days didn't quite understand some of the climate change issues we'd be dealing with today. But how much of a bind does that leave the Panama Canal Authority, particularly when you look at the forecast for some of the changes that we should expect in terms of weather and patterns?
Yeah, I mean, it is a problem. It's a problem that I think constrains their operational capacity, and it constrains the way in which they have fewer levers to pull, and they have an increasing number of constituents to serve. Not only does the canal, serve as this major shipping artery for the world, it's also the source of most of the fresh water that comes into Panama City, which is the biggest city in Panama. It's a multiple use zone, and as you lower the water levels in the canal, there's fewer and fewer levers to pull to make sure that the economy is driving forward rapidly with the resources that the canal provides, and that the people of Panama receive the fresh water that they need for the growth and the support of the city itself.
How many times have we seen this? I mean, we're talking about what happened over the last few months, but have we been in this situation before where we've had significant disruptions in the canal, primarily because of weather and climate conditions? Joshua.
Yeah. Go ahead, Steve.
Go ahead, Steve.
Okay, these events are almost always associated with major El Nino events, these major climate events that happen on average about once every 20 years. So the Panama Canal understands these phenomena very well. What is a little unusual is in the last 3 years, in the last 26 years, we've had 3 of these major events, and that's very unusual. We've never had so many major ENSO, El Nino-related droughts in such a short period of time. So that really is catching everybody here by surprise.
And Steve, just for the lay people out there, when we're talking about El Nino, we're talking about warming waters, right? That, I guess, warm beyond normal conditions. What's the net effect of that?
The net effect is it alters weather patterns at a global level. Some places get more rain than usual. Other places like Southeast Asia and Central America have their major droughts during these big El Nino events. They're completely normal, natural systems. It's primarily located in the Pacific Ocean, but it's such a major event, it has knock-on effects globally.
Joshua, if there is evidence to show that this isn't just sort of a one-time thing, that this is much more of a long-term structural change here, is there a solution out there? I mean, I know we talk about you can divert water from here and there, but you kind of mentioned the idea that these waterways and these lakes are also used for drinking water and other uses as well.
Yeah, I mean, it's a tricky one. I think the first thing to point out is that the patterns do suggest that the problem's not going to get any better, and it's likely to get worse in the future. One of the things we know globally is that climate disruptions tend to shift rainfall patterns significantly, and we're seeing that the rainfall pattern disruption in the data we already see. So I would expect, and I'm sure the Panama Canal Authority is planning for, continued variability in water levels within the Panama Canal and potentially worsening variability. And so then the question is, how do you manage that given the critical global importance of the canal and the national importance as well? There's a few things you can do. I mean, ultimately, what we're attempting to do, and we're working closely with the Panama Canal Authority on this, is make sure that the landscape provides more water at the right time into the canal. And that's about using the natural habitat to support water flows, regular water flows into the canal. So we have an experiment that's now 15 years old that is now implemented in the canal watershed, looking explicitly on how do you plant whole landscapes to absorb water effectively and then release that water during the dry seasons so that the canal has a steady source of water.
Is there, and Stephen, I want to come back to you too, particularly when it comes to the data that you're tracking and the climate conditions in that area. Is there something to extrapolate into what we're seeing over Panama Canal and over these lakes right now that can be extrapolated to the rest of the world? Is there some similarity or tie that binds?
Anytime you talk about climate, it gets immediately complicated. What we can say is what we're seeing here in Panama is completely consistent with many of the climate change forecasts, that there should be an increasing variability in the rainfall. So we are seeing in the same period of increasing frequency of droughts, we're also seeing a major increase in frequency of storms. And that is completely consistent with climate change. And if it is driven by climate change, we can expect that this would only get worse.
All right, going to have to leave it there, gentlemen. Really appreciate you taking time, and we should catch up again. This is a big topic that a lot of the folks, the investors who watch this program, have really been wrapped by. Joshua Tewksbury is director of the Smithsonian Tropical Research Institute down in Panama City, and Stephen Patton is director of the Physical Monitoring Program at that institute down there as well. All right, a lot more coming up here on the big program, including trouble in the skies. A focus on Boeing wrapping up inspections of that 737 MAX 9. Plus, we're going to talk about JetBlue and Spirit continuing to fall a day after a federal judge blocked plans for them to combine. All that and more coming up here on The Close. This is Bloomberg. Let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with Instacart. Bagging an upgrade today to outperform over at Wolfe Research. The analyst flagging the potential for an acquisition by rideshare giant Uber, and he's making the case that Uber is looking to expand deeper into grocery delivery, and Instacart itself could be open to a deal given some of the rising competition out there. He has a $35 price target and says a purchase of as high as $40 a share would be appropriate. Shares higher by 6% on the day. Next up, Rivian. The lights dimming as Deutsche Bank downgrades the EV maker to hold from buy. The analysts lowering expectations for unit production at Rivian and gross margins, citing prolonged factory shutdowns, which could lead to sustained significant losses here in the first half of the year. The price target going down to 19 from 29. The shares going down 7% here in the session. And finally, UBS shifting gears on Ford with a downgrade to neutral. The analyst says that while the headwinds for Ford, including waning pricing power and higher labor costs, those are industry-wide problems. But Ford may have more obstacles to overcome than its rivals, given execution and quality challenges, according to the analyst. Those shares moving lower as well, 2% lower on the day. And those are some of our top calls. All right, let's stay in the transportation space here and take a closer look at Boeing. It says that it's finalized inspections of its initial batch of 40 737 MAX 9 planes. Now, the Federal Aviation Administration here in the U.S. will review the findings to determine if the plane maker's fleet is clear to return to the skies. George Ferguson joining us right now, senior aerospace, defense, and airline analyst over at Bloomberg Intelligence. So I guess, George, it's good to see that they're making progress here on dealing with this issue. It does raise a lot of questions, though, as to how quickly they're going to get these planes back into service and whether this is going to be the end of the discussion.
Yeah, so I would imagine if they've already got 40 of these inspections completed, and now they're going to review their findings, I'd imagine that we're getting pretty close to the FAA sort of agreeing to the inspection regime. And, 40 for the U.S., I think we were talking about something in the, 170s or so. I think that means they could probably get a lot of those airplanes back in the skies within, a couple weeks to a month.
George, let me just jump in here with some breaking news. We have a headline that Apple must stop selling watches, the Apple Watches with the blood oxygen feature. This is, again, another legal setback in its patent dispute with Massimo. The U.S. Court of Appeals for the Federal Circuit declined to grant Apple a longer pause on an import ban of these devices that had been imposed by the U.S. International Trade Commission. We're looking at Apple shares already down in trading today, currently off by 0.75% at the moment. George, going back to what we're talking about when it comes to Boeing, what about the relationship between Boeing and Spirit AeroSystems, one of its suppliers? Does that remain intact? Is there a threat to that relationship?
Yeah, so for sure, that's where Boeing needs to concentrate its efforts on improving quality for the 737, in addition to its, its own factories. But Spirit AeroSystems is a core supplier in the 737. It makes the fuselages, it makes the wings. Boeing can't build the airplane without them. And so to drive higher quality on the airplane, they have to get it back into Spirit and make sure Spirit's production is stable and consistent. The relationship is one, I think, that Boeing is so dependent, they couldn't leave Spirit. I also believe there's an agreement that allows Spirit to build the 737 as long as there is a 737. So Boeing would need a new airplane to step away from them. So I think this is one of those relationships you just can't get away from. They're going to have to find a way to fix what's going on at Spirit.
It's a relationship they can't get away from, but it does raise the question, too, of whether Spirit's going to be, still around at some point here to actually fulfill some of these orders. I know that that's just kind of idle speculation at this point, but there's certainly some fundamental concerns that you can point to that would actually say that speculation has some merit.
Yeah, I mean, Spirit isn't in the greatest, health right now financially. They've been through some troubles. They've been losing money for a couple of years here. Boeing and Airbus actually, have forwarded advances, or whatever you want to call it. It's essentially a function, they're financing Spirit through some of these losses. So I think that shows you how important Spirit is to both Boeing and to Airbus, much more to Boeing, but also the Airbus, again, giving them advances, essentially, because if Spirit goes into the financial markets, last I looked at some of their bonds, they raised money at 9%. My guess is it might even be higher today. Yeah. It's really expensive for them to tap capital markets right now.
All right, George, great to catch up with you. George Ferguson there of Bloomberg Intelligence. A closer look at what's going on in the airline space. We do want to go back to the breaking news that we just got. This involving Apple and the Apple Watches. Apple Watches that it had temporarily pulled from its stores after it had a court order here that basically said it had violated a patent and told it to remove those products from the market. It had received a stay, but now learning today that the U.S. Court of Appeals has basically said they're not going to extend that stay any longer. Ed Ludlow joining us right now to talk a little bit more about what we know here. Ed, is this kind of the end of the story here? Is it basically any watches that have at least this particular Massimo patent in dispute, that's it? We're not going to see this on the market?
It is far from the end of the story. I mean, Apple shares didn't really react knee-jerk to the headlines. Look at Massimo shares. Those did rise a little. What the U.S. Court of Appeals for the Federal Circuit is saying is they are rejecting Apple's request for a longer pause on what was the International Trade Commission ban that was put in place. The mechanics of that are that they will have to stop selling the Series 9 and Ultra 2, but a much longer appeals process will play out, and Apple has said that that appeals process can last for about a year. So there's the process, and I guess, guys, there's a technology conversation to have about the long term of that product if the ITC finds them to be in breach of the patent that Massimo claims.
All right, Ed, thank you so much. Ed Ludlow getting to the set with more details on that breaking news. And as Ed was mentioning, Massimo shares are moving. They're currently up 1.7%, while Apple remains lower, down 0.7%. We have much more coming up. This is The Close on Bloomberg.
Welcome back to The Close. It's time now for our Wall Street Week daily segment with the host of Wall Street Week, David Weston. And it's a new year, so everybody is looking for the big themes. And you had a chance to sit down with somebody who gets paid to come up with some ideas for what the big themes could be for investors this year.
Why don't we have that job?
I don't think we can do that job as well as he could. But,
Ruchir Sharma does this every year. We sit down with him. He came out again with investing themes for this year. He's Rockefeller International Chairman, and this is what he had to talk about.
Well, David, as you know, this is also a very big election year globally, with more than half the population, or some estimate close to that, going to the polls this year. And the issue is that typically in election years, the pressure on politicians is to spend a lot, because that's the way they try and buy votes in a way. And that pressure is even more intense this year because the approval ratings of most politicians around the world is very low. And to try and win the election, the pressure will obviously be to spend even more. The problem here is the fact that the deficit levels, if you take countries such as the United States, are now far higher than anything that we have seen in the recent past. The US, for example, used to run a budget deficit of about 3% of GDP for much of the last 2 decades or so, on average. After the pandemic, that deficit shot up and now is likely to be at least 6% of GDP for the foreseeable future. So massive step function change that's taken place just in the United States. There are a few emerging markets too, from Mexico to South Africa, where the deficit levels have jumped up and they're all going to the polls this year.
Another major development we've seen in the United States, but not just in the United States, is immigration, and particularly undocumented immigration in the United States, which has really ramped up substantially. You point out in some of the charts you have that, in fact, 2023, I believe, will be the first time we have more undocumented people coming to the country than documented. What sort of pressures does that put on the economy and ultimately on business?
Well, firstly, the good news, which is that in 2023, the big story was inflation, as we started out, and labor shortages. This massive influx of immigrants that took place, not just in the United States, but also in much of the Western world in Europe, that helped ease a lot of the labor shortages, and that also helped take the edge off inflation, because there was a big supply side shock that happened in terms of the number of immigrants that came and increased the labor supply. So that's the good thing. The negative news here is obviously the political fallout of this, that these scenes that you see, and both from the left and the right, you get a lot of pressure. And I think that what we are seeing now is that the clampdown on immigration has started. And this could have adverse consequences in terms of the fact the same positive force that caused inflation to come down could now sort of turn into reverse, because you have such a big clampdown happening, because politically this is unacceptable. It disturbs the social fabric of a country. And especially now, as I think that people have turned more inward, there's a rise in more nativist feelings. So I think that the consequences here are that this was the big economic surprise of 2023, immigrants coming in, easing labor shortages, easing inflation in turn, also raising consumer demand a bit. Now, if you clamp down too hard on that, maybe politically good, but economically, there are negative consequences to it.
Another major issue for 2024 that you focused on is China and the path forward for China. It has been such an engine for growth globally for so long. It seems to be faltering a little bit right now. Is it not any longer catching up with the United States in terms of nominal GDP?
Yeah, so that's the point that I've made, which is that if you look at China's nominal GDP growth, really ever since the reforms started in the late 1970s, almost every year was in double digits. The China's nominal GDP growth in the 80s and 90s was close to 15-20% a year. And now that nominal GDP growth rate has slowed to 3.5%. So really, we have to go back to the Mao era virtually to come up with years where nominal GDP growth in China was this low. And the United States, the nominal GDP growth is much higher currently than 3.5%. So therefore, and especially with the Chinese currency depreciating and likely to depreciate even further from here, given the amount of stimulus that they need to do, what you're seeing here now is that the gap between US and China in nominal dollar terms, which is what people look at, even the Chinese policymakers secretly focus on, that gap was closing. China went from being a fraction of the US economy in the 1970s to more than 70% of US economic size by 2020. Last couple of years, that trend has begun to reverse itself. And the prediction that I've made, in fact, I also wrote about this over a year ago and have been saying so for a while, is that it may be that in our lifetime, China never ever catches up to the United States, given the demographic profile, given the debt profile. China just reported today that its population is shrinking again and is likely to keep falling by at least 2 or 3 million a year for the foreseeable future. So these are major headwinds that China has to encounter. So this is not just a growth engine just faltering a bit. This is a seminal change taking place in China.
That was Rashir Sharma, Rockefeller International Chairman. So, Romain, tomorrow you and I are going to be talking with the head of Amtrak, talk to him some about infrastructure and what we need and what they're getting. That's coming up on Wall Street Week.
Oh, yeah. I got a lot of questions for him. So that'll be a good one. And, of course, you can always catch David Weston every day around this time here on The Close as we round out into the final hour of trading, the second day of declines here for the major indices, 4 days for the Russell 2000, a repricing of some of the repricing of Fed expectations, a full breakdown after the break. Right here on The Close, this is Bloomberg. Just about 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Romain Bostic.
And I'm Scarlett Fu. And Romain, it looks like good news is bad news for the market.
Yeah, I mean, this is a market now that is really having to reckon with the idea of, frankly, I guess what every central banker around the world has been telling them for quite some time is kind of slow your roll here when it comes to those rate cut expectations. The economic data that we got this morning, U.S. retail sales appearing to sort of feed into that. And you see the drop here. It may not seem like much, 0.7% on the S&P 500, but we're now starting to test some of those key technical indicators to the downside. So this becomes not just a fundamental story, but for those technical traders out there, this could actually accelerate the sell-off should we continue to breach those levels.
And it's a pretty stark contrast to the end of last year when you think about it economically, fundamentally, not a whole lot has changed.
One of the few bright spots that we're seeing out there is a lot of the managed healthcare companies, United Health moving a little bit higher here on the day. And then you see at the bottom there, the Crane shares, the K-Web ETF here. We had a huge sell-off over in China, particularly in Hong Kong, down about 4% on the Hang Seng. And that, of course, fed into a lot of the U.S.-listed Chinese stocks, ADRs here in the U.S.
I bet Carol Massar will talk about that later on.
Yeah, she'll definitely hit up one of those. Flip up the board, too, as well, because also overseas, there was a big sell-off in the luxury space. And this is becoming a big issue here because we talk about consumer spending and particularly how it relates to the Chinese economy. When we got all that Chinese data, the first thing everybody thought of was, what about these luxury goods makers and the Chinese consumers that they can continue to be dependent on? There's been a huge sell-off here on a lot of these names. Keep in mind, Richemont is scheduled to tee up tomorrow overnight U.S. time, I should say, so in the morning European time. So it'll be interesting to see what kind of commentary they give on whether luxury spending is going to hold up.
Yeah, we've heard from Burberry already that things are not looking great on that front. All right, let's continue the trend here and take a look at some individual movers. And unfortunately, it's to the downside once again. There's a theme today, certainly. Spirit Airways extending its drop after a judge blocked its merger with JetBlue earlier this week. It plunged 47% yesterday for its worst one-day sell-off ever. That takeover by JetBlue would have been a lifeline for the discount carrier, but now analysts are saying Spirit may face a prospect of a bankruptcy filing.
Yeah, I mean, you kind of see the writing on the wall here. I mean, Spirit had a lot of issues prior to this announcement here. And I think the fact that they were sort of tied up in this, it might have actually hurt them, right? Because if you thought you were going to end up being under the sort of the umbrella of JetBlue, you maybe weren't making as many changes at the company. So they've lost a lot of time here.
Back to square one. Yeah. You had mentioned K-Web. Let's bring up another ETF that tracks Chinese big cap stocks, FXI. Of course, you talked about the data dump that came out of China. Are you just saving the Golden Dragon Index? Because I was going to use the Golden Dragon Index, and I said, no, that's pretty much Carol Massar. Right, exactly. No, I want to give another option out there, right?
Retail sales. It, the Carol Massar
totally, the Carol Massar Golden Dragon Index. Retail sales, fourth quarter GDP, jobless rate, all worse than expected. And here's a name that you've been focused on, Schwab, down as much as 7.2%, declines in profit, new assets, and deposits as rate hikes eroded the value of its investments. Yeah, we got to revisit that a little bit later when we have more time, because I thought some of the comments by the CEO were really illuminating here. We are about an hour away here from the closing bell, and our cross-platform coverage of today's top stories starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostic alongside Scarlett Fu. We're joined right now by our colleagues Carol Massar and Tim Stenovec. A hearty welcome to all of our audiences across all of our platforms. Bloomberg Television, Bloomberg Radio, Bloomberg Originals, Carol Massar.
Yes.
And yes, those folks who are still streaming us on YouTube. Happy Purple Day, by the way.
Thank you very much. Yeah. And we love those people on YouTube. We love them everywhere.
I do.
Having said that,
not on X, but YouTube. Yeah.
All right, we're going to table that for a moment. Having said that, listen, we've all been
Would
talking.
Would you like to comment, Tim, on that?
Yeah. I'm going to let you two work.
We love every platform that loves us. Let's put it that way. Okay? Is that fair?
Yeah, that's fair.
All right. Also fair is, I don't know about you guys, but it seems like we were all shopping in December, right? We talked about the retail sales number. I think you guys probably did too. Having said that, so consumers seem to be okay out there shopping. Whether they're doing that on credit, we can debate that later on. But having said that, U.S. home builder sentiment also seeming pretty positive. We're seeing it increasing by the most in nearly a year. And I've got to say, Tim, as we see any kind of pullback in mortgage rates, that's got to be part of the reason why.
Yeah, in fact, because rates are falling below 7%, although today I just checked, they're exactly at 7%. Some builders are stepping back from cutting prices. Romaine, 31% of builders this month reported lowering prices. It's the smallest share since August. The average reduction held at around 6%. That's according to this report. I will say, even though we're talking about mortgage rates at 7%, that is still historically high, at least if you look over the last 2 decades.
But
Before
still,
the pandemic, it was at about 4%.
But if we're talking about actual home builders, so new homes, I mean, and you overlay sort of the stock performance, as well as, I mean, the fundamental performance, I mean, it really defied a lot of expectations last year, primarily because the existing home sales market is just such a mess in terms of affordability that they kind of benefited from that. So I think even when you look at some of these, the higher mortgage rate numbers here, it begs the question here as to whether these home builders still have enough in the pipeline that it's not going to really matter.
Beyond that, of course, the builders also obvious mortgage buy-downs too.
Do you guys see the sun?
Yeah, it's shining very
Is it going to melt
It's the halo around your head.
Well,
he
is
is
it going to
kind of
melt
an
the
angel.
ice?
He is an angel.
I just want it to melt the ice. That's all I want. Warm up.
Yeah, watch
warm
out
up
for the falling
streets,
ice.
please.
Or is it a
Yeah.
UFO?
No, let's not go there.
All right.
Let's talk about another story that crossed the Bloomberg about how average cash bonuses are down, and it's a sign of how employers are regaining leverage in the relationship between employers and employees. The average cash bonus last month down 21% year over year.
Ouch.
This is according to Gusto, the payroll software company. And what's interesting is that every industry posted a decline, whether you're talking about tech or tourism or transportation. Remember, the hospitality industry has been having a hard time finding workers, too.
Yeah, absolutely. I mean, that was the lead one, tourism, too. But I mean, I'm curious as to like how they sort of aggregate this, right? I mean, I guess they're just taking everybody in the pool here because we've kind of heard mixed anecdotes here about how there's still sort of certain tier of people that are still getting their bonuses at a level that I guess they would be happy with, while other folks are either getting nothing or a lot lower.
I think it's just interesting when we try to figure out kind of the way forward and what's going on. And the labor market, right, has been something that everybody keeps scratching their head. It stayed strong through all of this. If we're starting to see weaker points and that companies don't have to pay bonuses. Remember when they were doing it for, was it fast food workers? Like everybody.
Signing bonuses and everything, right?
Right, exactly.
Yeah.
So if that is starting to weaken and go away, then maybe, there is some weakness in the labor market that we don't necessarily see in those monthly stats.
Yeah, those are really tantalizing. I almost quit. I was going to work at Popeyes.
There's also non-monetary perks too, right? Work
Yes.
from home, hybrid work, free lunch at the office, that kind of thing.
Which place would you go to work, Romaine?
Choose carefully.
Are you coming with
This is
me?
a trick question.
Are you coming with me, Carol Massar?
Yes. I'll flip the burgers and you can
And
do
I
the
do
fries.
the fries. Wonderful.
All right, we're going to continue this
Match made.
conversation.
I'd watch that show.
Meanwhile, Tim Stenovec blinding me here.
Yeah, this is
Can
probably the
somebody
last
fix
day
that?
they're gonna let me.
Is there a
sit here.
reason why they have you in a glass booth?
Is my neck gonna get sunburned?
I think so.
For the
Tim.
next 3 hours, that's what I want to know.
I'm going to go back to what Scarlett was it you said? He's angel-like?
He's an
or is that
angel,
Romaine?
yeah.
Yeah. He's angel-like.
Oh, very kind.
Romaine, you
Beware
can
false
learn from
prophets.
Tim.
Yeah.
I'm just saying. All right, we're going to be back in less than an hour's time. We're going to wrap up this trading day on this Wednesday. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Folks, we will see you at 4 p.m. Wall Street time.
And we continue our coverage right here on Bloomberg Television, counting you down to the closing bell. We're just about 50 minutes away from those bells. And pleased to say, Mike Contopoulos is joining us here on set. He's director of fixed income over at Richard Bernstein Advisors. And don't worry, there are no windows in this studio, so no sunlight blocking your eyes. But I am curious as to kind of your view right now of what we've been seeing with this sort of repricing, if you want to call it that, in the rates market. This idea that maybe pricing in, 6 to 7 rate cuts might have been a little extreme.
Yeah, I think it's absolutely extreme, Romaine. I mean, when you look at the market's narrative, it's very much a soft landing scenario. But we don't see a soft landing. I mean, if anything, we think the economy is actually starting to accelerate. And we've been talking about that now for going on a couple months. The market really hasn't believed us. But look at the data. I mean, retail sales this morning, industrial production, LEIs are bottoming. I mean, this doesn't really look like a soft landing per se.
Wait, so no landing?
No landing. No landing. I mean, earnings growth is accelerating as well. When you look at earnings, and earnings are going up, right? We're negative over the last several quarters. We're gonna be positive shortly, and we think earnings growth is going to continue to accelerate through the first 2 quarters of this year. And so that's not the makings of a soft landing, which implies sub-potential growth.
Well, okay. Well, if you buy into that, and we should point out, you're not alone in that thinking. But if you buy into that, then you have to start to be worried about what the Fed does, right? It not only becomes a question of whether they cut rates, but whether they leave rates where they are, or even, God, should we even say it out loud, whether they would actually be inclined to raise rates.
Well, I'm glad you said that. I mean, I don't think raising rates should necessarily be the base case, but there's no way it can be off the table. Inflation really bottomed. I mean, depending on what inflation measure you're looking at, of course, but inflation really bottomed 6 months ago. Bottomed in June of 2023. And that's not, the makings of inflation coming under control. And so I think you should absolutely have a probability out there for another hike, but certainly no hike for the next 3 or 6 months. I mean, I don't know how the market could be pricing in cuts here, given the economic data that we're seeing.
And yet they persist. So let's talk about positioning and, of course, pricing right now. Most of the juice, you say, has been squeezed out of the fixed income markets. What do you mean by that?
Yeah, I mean, if you look broadly across most of the major asset classes, in particular rates and credit, I mean, there's just not a lot of total return performance that can happen there. I mean, spreads in the investment grade market as of yesterday, Scarlett, I think were on the Bloomberg index sub 100 basis points. Very rarely, when you're inside of 100 basis points, do the next 12-month returns even equal your coupon. In other words, you get coupon less over 12 months when spreads are this tight. So corporate credit just doesn't look attractive to us at all. It's pricing in the best of times already. Then you look at treasuries and given
I'm sorry, can I just stop you there? But you're all corporate credit, or are you talking about just investment grade?
Investment grade is probably the worst of the bunch from a spread basis. High yield doesn't look good either from a spread basis, but at least in high yield, you're earning a pretty decent yield, right? So ironically, I would rather lower quality than higher quality in this environment, which maybe isn't that ironic given that we think things are taking off a bit. You'd want to be in lower quality. But all of corporate credit, in our view, is somewhat expensive. There are areas that are a little bit cheaper, like preferreds, for examples, or we really like CLOs. We think CLOs offer some value, but traditional fixed rate corporates are not top of our list there.
So you're saying they look expensive, but it might be a good time to issue those bonds if you're able to. A lot of the big banks, for instance, the 4 of the 6 biggest banks have done so already, and there's going to be a lot more supply coming onto market. So they're going to do it while they can.
I think they're going to do it while they can. That should also pressure spreads, right, as they issue a ton of debt. But yeah, I mean, just the fact that they're issuing goes to show you that corporates, are trying to get ahead of potentially higher rates as well and lock in, this big move that happened in the 4th quarter and coming into this year. And so I do think you're going to see a lot of issuance. That could pressure spreads. I think you're going to start to see volatility increase, both rate volatility and the VIX. The VIX got down to roughly 12. We're seeing that start to spike now. Listen, credit investors hate volatility. We want the certainty of coupon and ultimate payment principal. So volatility is not good for corporate credit.
But is that going to be kind of what we saw in 2023? Because that volatility in the fixed income, they started to stamp down later in the year here, and we've seen a big spike back up over the last week or so.
I think this year is going to be a year of more vol than is expected.
Really?
Certainly for the next 6 months or so, because of the way the market has sort of wound vol so tightly. What happens after June, I don't think anybody really knows. The crystal ball gets cloudy as you look over the back half. But for the next 6 months, I'd expect higher rate vol and a higher VIX.
So there's no confidence of extending duration in that environment, or is there?
I don't think it's time to be a hero and extend duration in any meaningful way. I'd rather be underweight duration. I mean, you can still take interest rate risk. I mean, I don't mind a little bit of interest rate risk in the portfolio, but I don't think you should be overweighting duration to any large degree here. Instead, I'd look for alternative ways to add good income to your fixed income holdings without taking a lot of credit risk and interest rate risk. And there are ways to do that, whether it be through preferreds or AAA CLOs or other sort of non-traditional ways.
Yeah, but the fundamental outlook here from you is that the first quarter and second quarter are likely to be stronger than a lot of people are pricing in. Mike, thank you so much for joining us today.
Charlotte.
Mike Kontopoulos is Director of Fixed Income at Richard Bernstein Advisors. Now, coming up on the close, U.S. retail sales coming in hot, rising by the most in 3 months. We've got more on what's fueling consumer demand.
Plus, the iPhone dethroning Samsung to become the best-selling smartphone in 2023. We're going to break down those numbers, and we're actually going to talk about what Samsung is doing next to recapture that crown.
Remember those foldable smartphones?
Yeah, I never got those. I see them all the time.
Yeah,
I just
not
don't get
into
it. Yeah.
California's new billionaire-backed
I
city.
think if I got one for free, I might use it.
We all would like something for free. That city is heading to the ballot. We're going to have more details around the secretive project. That's coming up on the close. This is Bloomberg.
This week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As markets anticipate a dovish pivot by central banks, policymakers grapple with two wars on the global stage, and AI continues to dominate the tech headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Continuing coverage this week, only on Bloomberg Television and Radio.
Just about 43 minutes until we get to the closing bells here on this Wednesday afternoon. You take a look at the board behind me. These are actually the most significant gainers here on the day, and no disrespect to any of those names here, but that's not enough to keep the market afloat. When Alphabet's down 1%, Nvidia's down 1%, Tesla down 2%, and Apple down 1% as well. In fact, all of the Magnificent Seven moving lower here on the day by about 1% as a whole, and that's pushing the S&P down by about a similar amount here on the day. But of course, a big topic of the day is what we've been seeing in the rates market. 12 basis points higher on the 2-year yield. You combine that with the 7-8 basis points that we got yesterday here, and a very significant repricing here of where people think rates should be. That's based largely on the retail sales numbers that we got this morning here in the U.S., as well as those comments that we had yesterday out of Fed Governor Christopher Waller. We get more Fed speak later today, as well as tomorrow and on Friday. That could drive the narrative, particularly as we start to break free from the macro perspective and start to focus a little bit more on earnings. But the macro, Scarlett, continues to dominate, and that will be the big driver of markets until something else can wedge its way in between.
Absolutely. That's what happens when you're in a data-dependent world. All right, let's go out west now, because the brains behind a new California city, they're sharing more details around their secretive project, and they're seeking funding by wealthy Silicon Valley investors before pleading their case to voters for support. So joining us now to break things down is Bloomberg News California Bureau Chief Karen Breslau. So Karen, share some of the details with us. What have we learned about this mythical city that will be built on farmland northeast of San Francisco?
Well, the myth is getting some pretty pictures and some rough drawings, and it's described as, what California needs, which is housing, a walkable community. I think if I was just putting on my political hat and trying to figure out what would make a ballot measure win in California, if you told Californians you can live in a place and walk to your job or to shopping or a cafe or a cultural event 10 minutes from your house, it might be a win. And that's what the organizers are hoping.
Karen, why was this so secretive? I think that was the word that we used here. I mean, if this is to legitimately address some of the issues when it comes to housing, when it comes to the population issues here, why go about this in the way that they did it?
Well, that I think is going to be their biggest obstacle. So what the organizers of California Forever say is that they were worried about a land bridge, and in fact they were driving one covertly, and they're still involved in litigation, which has certainly created a lot of political backlash here in the community. But they now, having assembled this incredibly large portion of Solano County on the outskirts of the San Francisco Bay Area, and becoming the largest owner in the landowner in the county over a 6-year period, a 6-year covert buying spree, they're now trying to turn it around and tell their story to the community and first to the voters who they need to approve substantial changes to the county zoning laws here in Solano County.
So there might be a lot of misconceptions here or misperceptions because we talk about how this is billionaire funded. You've got Mark Andreessen, Reid Hoffman, the co-founder of LinkedIn, Laurene Powell-Jobs also involved in this. Will they be living in this city or are they just putting money behind it? How is it going to work?
Behind it. These folks have their housing. Michael Morris, they've all got several houses, in fact, and most of them live in and around San Francisco and Silicon Valley. We're about an hour northeast, a little bit more if you include traffic. So these folks are not looking for housing, and I think one of the most interesting questions in this entire exercise, given how long the time frame is to see any kind of return on investment. Jan Schramek, who's the CEO of this operation, told us yesterday that he's looking at a 50-year, i.e., a half-century time horizon. Silicon Valley isn't known for its patient money. And I think what they really want to do is show a new kind of American city, particularly in the post-pandemic era when we see cities, really in decline, not only San Francisco, but a lot of cities struggling with the way we live now, which is with people looking for work-from-home opportunities, for more walkable communities, more sustainable communities in terms of energy supply, and that's what this project aims to. Be a demonstration project.
All right, Karen, thank you so much. Karen Breslau joining us, the California bureau chief. And Romain, what's interesting, of course, is that there will be no freestanding suburban homes that California is famous for. What they envision are townhouses, apartments, like three-story townhouses, and auxiliary dwelling units.
Okay, well, with me when they actually complete this thing. I mean, because
50 years.
50, how am I?
50 years, 50.
50. Yeah. Okay, well, good luck with that. Good. Kudos to them for trying to find a solution to what is a legitimate problem. But it does raise a lot of questions as to why you can't sort of address the issues in, say, San Francisco or some of the other major cities on the West Coast I guess just do this in a more transparent way. And I think that what seems to rankle a lot of people, particularly when we talk about the farmers and other people who are dependent on that land and the water that serves that land to all of a sudden see that sort of being taken out from under them and being diverted. It makes you question just how amicable and, more importantly, how altruistic this endeavor really is.
Yeah, the secrecy phase was never a good sell for them, and it was not a good look, and it threatened to hang over this project for years to come.
Yeah, and maybe, I don't know, you mentioned how it's not all billionaires. Maybe they should put some of those folks up center instead of just listening to, Mark Andreessen pontificate about God knows what. All right, still a lot more coming up here on The Close. Stick with us. This is Bloomberg.
Samsung is turning to AI to revamp its flagship Galaxy smartphones. It's betting the technology can give it an edge over Apple. So that's 3 cameras or 3 lenses. I mean, it looks kind of similar to the iPhone, the latest iPhone, which also has 3 lenses. But, oh, look, there's 5. There you go. Clearly, that's a reason to upgrade, right?
No. I guess it depends. I mean, look, there'll always be like the real tech heads who will adopt this once. But it gets to the idea here, if we kind of reach peak phone, I mean, everyone keeps talking about peak television, but I mean, you mentioned the 5 cameras there. I don't know. Do I need a fifth? Do I need a fifth
Maybe
lens?
you need different angles for your selfie.
I don't. And also the price of this is crazy. So $800 for the entry-level model, and the top of the line is $1,300.
Not so different from Apple. And of course, this comes because Apple's iPhone dethroned Samsung devices yesterday to become the best-selling smartphone series over the course of 2023.
Yeah.
So
Are there big
down.
differences between these phones, though? I mean, I know some people just have a preference for iOS.
The operating system
Android,
is different.
But as far as the hardware itself, it's kind of all the same stuff, right?
It's all the same stuff in that it's good for a while until a new version comes out.
All right. Well, we're going to talk a little bit more about Scarlett's new Samsung S24. This is The Close on Bloomberg. This is the countdown to the close. Just about 30 minutes left to go here, Scarlett, and not looking good here for U.S. equity traders.
Yeah, 2 trading days this holiday shortened week and 2 days of losses, pretty steep losses at this point as well. If you look at the IMAP behind me, that really maps out the 11 industry groups in the S&P 500, red across the board. Your worst performers, of course, are the more rate-sensitive sectors like real estate investment trust. All the members of that sub-index are down. Utilities, 29 out of 30 names in that group is lower. Consumer discretionary, which includes home builders, automakers, and retailers losing 1.2%. And on the flip side, you're seeing consumer staples, healthcare, and financials outperform in that they're down less than all the rest of the sectors. And of course, this comes remain as investors are repricing exactly what the Fed is going to do.
Yeah, a lot of red on that screen there. So let's talk about some of the individual decliners here on the day. Alcoa down for a 5th straight day, down about 2%. Remember, we're supposed to get some earnings out of them. And there's a lot of concern here that we're not going to like what we hear. Remember, the last 4 earnings days or post-earnings days, we've seen the shares sell off pretty significantly here. We'll find out whether 5th time keeps that trend going. Bank of America also down here. Bank of America actually down for a 7th straight day, down only 1% here. But when you talk about the trajectory of this company relative to its peers here, now they're starting to look like a laggard in a way that they didn't necessarily were in the years past. Mosaic also lower on the day, down for a 9th straight day. That's its longest losing streak going back to 2015. But I do want to end here on a bright spot, Scarlett. Sinclair Broadcast getting a strong bid here, up about 16%. This is actually on the back of a deal that we're learning about here to basically save this company out of bankruptcy. Remember, Diamond Sports, which is owned by Sinclair, had actually started to wind down operations after the 2024 sports season. We're now learning here that they have reached a deal with creditors as well as with Amazon, which will take a minority stake in that company here. That will save Diamond Sports, and of course, that's giving a bid to one of its primary owners here, Sinclair Broadcast, up 17%, Scarlett.
Yeah, big tech to the rescue. All right, let's talk about the consumer because job security and purchasing power are some of the factors driving consumer confidence so far. January's LSEG Primary Consumer Sentiment Index finds a slight 1.8% increase in consumer confidence from the previous month. However, there are still signs that not all Americans are confident about the economic outlook. We're joined now by Jerome Martis. She is Director of Consumer Research for the London Stock Exchange Group. Jerome, always good to see you. So what I always find puzzling is whenever we talk about the consumer in aggregate, it doesn't really do it justice because there are different ranges of consumers. You have high-income consumers, lower-income consumers, and whenever we say the consumer is strong, in aggregate, the consumer will be strong, but different consumers are feeling pressure points at in different places.
Yes, but what's interesting about this report, the one today, is that 2 areas stood out. The fact that clothing and accessories did so well, and department stores even saw a 3% jump month over month. It's interesting because these are exactly the 2 sectors that saw the highest amount of discounting. So although the high-end, middle class, and low-end consumers are feeling pressure everywhere, and they've proven to be resilient in 2023, without a doubt, we're now dealing with a consumer that's been conditioned to only open up their wallets if they're finding a promotion or a discount. So that's how we're entering 2024, with a consumer that has proven to be resilient, but also is shopping and hunting for those discounts.
Yeah, so the takeaway for businesses and companies is if you want to continue to sell your goods or services, you've got to keep discounting or offering the perception of a discount.
Exactly, that is correct. And so when we look at the numbers go in December, almost half of all the merchandise was on sale, which is why those 2 sectors saw those strong numbers. But now going into January, we saw a significant drop, which means 2 things. One, retailers moved that inventory. They had a jolly Christmas. And the second one being that now we're introducing inventory, like new spring merchandise at full price. And it's going to be interesting to see if that is strong enough to entice the consumer, to continue that strong trend that we saw.
Well, that raises the question as to what people have been buying. I mean, I know, department stores closing, but are they buying the things they need, meaning like I need a new suit for work or I need new pants, for my child to go to school? Or are they actually buying discretionary items that are maybe just because they, looks pretty?
No, this was the first time we saw them actually extend themselves a little bit more to those discretionary items. So the consumer had been sticking to those staples for a very long time, but this was the first time we actually saw an extension further to things that just look pretty, like you mentioned.
Well, I pose that question then because if they're still buying some of the more discretionary items but just waiting for a discount, does that still suggest, though, that at least in terms of consumer confidence, that still is relatively high, and maybe we can draw a line to say that might keep consumer spending going?
It will, as long as the job market continues to remain in good condition.
Yeah.
That is the one economic indicator that consumers...
Have you ever been to this holiday market
understand
down
very
in,
well.
in Union Square, New York? It's like
Yes.
a mess. I don't know why we're showing it, but anyway,
Yeah,
I'm sorry.
no, I've been there.
Did you buy anything from there?
My son loves the hot chocolate there. So again, it goes back to also...
That sounds like when my family goes down. We just end
Yes.
up eating our weight in donuts and hot chocolate.
But that goes back to the retail numbers today, because if you notice, the strongest year-over-year number was, again, food and drinks. So the consumer is still gravitating to spending the biggest chunk of the discretionary income towards those experiences, even though they extended themselves a little bit again to the mall, but mostly to food and eating out.
So, and that makes sense given it was the holiday season, right? I mean, the experience of going to a holiday market, never mind the fact that Romaine's not into it, means that you buy hot chocolate and you eat the different things available.
I mean, it's outdoors and it's cold.
That's why you drink hot chocolate. What does it tell us about consumers' willingness to spend on goods versus services? It's cheaper. It's obviously you're able to discount goods, but you can't really discount a cup of hot chocolate.
Absolutely not. In fact, even when we look at the forecast for the remainder of this year, 2024, that's where the strength is consistently. That's where analysts polled by LSEG remain bullish, and even for the year, we expect to see restaurant sales earnings still up around 80%, which is insane considering how strong they were the year before. So that year-over-year comparison is very difficult, yet it's still expected to be strong for 2024.
So what is the takeaway for companies that know that they need to discount in order to bring in the consumer and to get their interest, but doing so conditions consumers for expecting that even further? I mean, you don't want to devalue your brand.
Right, but with the retailers that in a smart strategy way during the holiday season was that even though more merchandise was on sale, the average discount was still the average that we saw all year round. So it's also about being smart how you market that product in order to lure the shopper in, because more merchandise was on sale, but then the discount offer was still below that 40% mark.
Got it. Jerome Marty, thank you so much. Director of Consumer Research for LSEG. And Romaine, that 40% level is something Jerome has talked about. That gets my attention. If it's 30%, I'm not interested, but 40% definitely looking.
Yeah, I didn't actually find the sales that good on a percent basis, at least relative to years past. And to her point, too, also those percentage discounts seem to be kind of what they were offering all year long. So when you got to the holiday season, I was like, well, what am I really saving? And now, post-holiday, I feel like a lot of men's stuff goes on sale. I'm not seeing it. I don't know, maybe it's all women.
They manage their inventory
bias.
well. That's what it comes down to.
Yeah, okay. That hurts me.
Yeah, well, you can blame gender bias. I'll say they manage their inventory. Well. All right, coming up, we've got the top three, where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close on Bloomberg. It's time now for the top three. Every day at this time, we do a deep dive into the people at the center of the day's top stories. Today, we're focusing on the names making news at Davos. And the first name is Christine Lagarde. The ECB president was asked at Bloomberg House about the upcoming U.S. election, Romaine, and she made the audience laugh by promptly lifting her cup of coffee and saying, yeah, let me have some coffee first.
Yeah, I mean, she was,
impeccable timing.
Yeah, look, let's face it. I mean, U.S. politics are something to behold these days, and we'll just leave it at that. If you're an American citizen, but I can only imagine what it's like if you are someone like her who has to sort of deal with U.S. policymakers, and at least she primarily gets to deal with like the more sensible policymakers like Jay Powell, and doesn't have to deal with Congress and the like. But let's just say a lot of us felt that sip of coffee.
Yeah, well, she was in Washington when the Trump administration was in full force, so I think she has some personal experience there, Romaine.
All right, I'm keeping an eye on Mary Callahan Erdos, who leads JP Morgan's Asset and Wealth Management Division. She was actually speaking about what she says is an increase in hackers attempting to infiltrate a lot of systems at the Wall Street giant, as well as its rivals. Basically, this is a big issue for her and for her peers in terms of dealing with cyber crimes. And I think any of us know, at least from the consumer side of it, I mean, how many like phishing attempts do you get coming into your text messages or into your email box? And they're getting better. I remember, I felt like a few years ago, you can just spot them a mile away. You could tell this was obviously phony. And now I've gotten a couple where I was like almost like hovering, ready to click on that thing.
Fell for it.
And I'm like, wait a minute.
Yeah,
I don't have an account with Chase.
You did the proper training here.
Yeah.
JP Morgan now spends about $15 billion on tech every year as part of its attempts to bolster its cyber defenses. That's up almost 5% from the same time last year.
Yeah. I don't know what the solution to that is. Did we just go back to cash?
Go back to the Stone Age? Well, the banks would, some of the retailers wouldn't mind having to pay the credit card fees. So there's that. All right, our third person that we're watching is Guggenheim CIO Ann Walsh, because we're smack in the middle of bank earnings season. And she says she's worried about regional banks. Quote, they've got several risks happening at this point in time. They've got commercial real estate and a refinancing wall in that space and a refinancing wall in their commercial and industrial loans. I mean, ... It kind of goes on, doesn't it?
Well, I think it's interesting because when I first heard her comments, I was like, really? But then when I kind of heard her explanation, I was like, okay. I mean, because if you think about it, the commercial real estate crisis, if we want to call it that, clearly has not been resolved or sort of played out. And if you were betting on a drop in interest rates to maybe sort of blunt the potential impact of some of that refinancing risk, maybe you're not going to get that, at least based on some of the price action we've seen the first couple of weeks of the year. And then, of course, we've seen deposit flows. They've not come back to where they were pre-SVB for most of these banks. And that's something that I think a lot of people aren't talking about.
And bottom line is these banks have a more limited capacity to lend, which means there's less credit availability for small businesses, which create all the jobs. And, of course, for consumers, even as we see interest rates stabilize and, the mythical rate cut eventually happens.
And then, of course, don't forget about the whole issue of regulation. And we were talking about that a little bit earlier. You still got this big capital rule proposal that the Fed is trying to push out. Presumably that's going to be done sometime this year in theory. And that could affect at least the super regionals, definitely affect them in terms of what their capacity is going to be to lend and just basically do regular business.
That's why it's so interesting when you have Fed officials like Michelle Bowman, talking about the regulation front too, and about how maybe there needs to be some more changes because that's something that will definitely move the banks. That's something that the bank CEOs are watching for.
This is, I mean, we're kind of at a pivotal time, too, because how much have we talked about how much money is leaving the traditional banking system, whether it's the big banks and sort of all those deals now that are going through private capital firms before maybe they get syndicated through the banks. And now you're talking about on the consumer side, deposits that have outflowed from regional. Some of that went to the big banks, but some of that went elsewhere. And there's no real way to know if that's going to come back.
Spot Bitcoin ETFs, anyone?
that or short-term treasuries. I mean, all that money has gone elsewhere. So, anyway, something to keep an eye on here as we move deeper into the year. Meanwhile, here on this Tuesday afternoon, we move closer to the closing bells. 14 minutes ago, Diane Jaffe, TCW Senior Portfolio Manager, is on deck. Stick with us. This is The Close on Bloomberg. This is the countdown to the close. Romaine Bostick alongside Scarlett Fu with about 10 minutes until we get to those closing bells. Scarlett, today not shaking out much different than yesterday here, red across the screen for all of the major U.S. indices.
Yeah, but we've come off our lows here in the last 30 minutes or so, and we have a situation where bad or good economic news is bad for the stock market. The hotter than expected retail sales report is causing everyone to rethink whether the Fed is actually going to cut rates by 6 times as so many had priced in, or maybe they'll actually stick to what they had planned, which is 3 rate cuts. Nevertheless, you're looking at the dollar strengthening for a 4th day. That's been a continuing story the last couple of days, higher versus all the major currencies except for the pound. The 2-year note, obviously very sensitive to those rate cut expectations. Price down, yield up by almost 13 basis points. And crude oil has turned around, actually. So that's an interesting move there, because if it continues to persist, maybe that could be inflationary.
All right, let's get right to our next guest as we continue to count you down to the closing bell. Diane Jaffe, TCW Senior Portfolio Manager, joining us right now here in Studio 2. Great to see you, Diane.
It's great to be here, Romaine. Thank you.
We've been talking all day, and really, quite frankly, to start the year, so much about macro conditions, so much about the pace of rate cuts and how that's feeding into the market. We've got an earnings season afoot here. We got the banks. They're pretty much out of the way. Next week, we get about 70 names out of the S&P 500, and we get a bit of a broader swath of what's going on on out there with these companies, and hopefully we get a read on the economy as well. Are you optimistic about what we're going to learn out of these earnings reports?
Yes, I am. I think the banks led off, and there was a little bit of disappointment, but Q over Q, fourth quarter over fourth quarter, it was going to be a little difficult. We want to look forward for the banks for the rest of the year, but when we've already seen sales for the fourth quarter companies that have reported is up 6%. That's a pretty decent background for the broader swath as you were talking about.
And when we talk about sort of earnings expectations, we always sort of do it sort of through the lens of the benchmark index, the S&P 500. And there are a lot of people say that's not really a reflection of the economy. But when you look to the broader market, you go to the Russell 1000 or Russell 2000 or 3000, whatever, you do get a much broader swath of what represents the economy here. Is that going to reflect anything different than what we're seeing in the S&P 500?
Oh, that's such a good question.
Thank you. I've been thinking about that one a lot.
You're always thinking. So I think we're going to see that the Russell 1000 value is going to be poised for high single-digit, low double-digit earnings growth in 2024, and that's about the same, maybe a shade less than the S&P expectations because of that growth component. But when I think about it, I think, high single-digit, low double-digit returns on the value index, but I'm, paying, 40% less. That's a day in the market for me that's really good.
What part of the earnings season this time around do you think has the potential to surprise investors?
I think that if we look at consumer discretionary, it was the leader all last year, and it really was the bright light in the sea of darkness in terms of the strength of consumer when everyone was thinking they were really, packing it up to go home. I think that consumer discretionary should continue to surprise going forward, albeit, there aren't as many fiscal stimuluses for them, but having gas prices come down is a big shot in the arm. The other area that we really like, that we think your viewers would like to think about, is healthcare. Right? They're selling so inexpensively, and yet they just plotter along and keep generating good earnings growth.
How much of the story is about M&A and trying to pick the winners there, or the acquisition targets? Because there's been so much deal making, and deal making begets deal making.
It also is a signal that investment bankers and the strategic acquirers are saying, okay, I'm in a better place right now because things are a little more on firmer ground. For us, we're not looking for companies to be taken out from our portfolio. Generally, the quality of names in our portfolios are making the acquisitions. And that's been a big positive year to date in terms of strategic acquirers looking for strategic assets. And I think that says something about the strength of the economy going forward. Not that it's ever a straight line, but that they're better poised for future growth.
It's interesting, though, that a lot of the M&A activity, at least the announcements that we've gotten over the past few months, have been kind of confined to healthcare and to energy. I think we've had a couple of tech deals, but it seems like the lion's share, if you add them all up, is much more in the energy space and much more in healthcare space.
They're inexpensive. They're inexpensive, and that makes bankers and strategic acquirers get, wet their whistles a little bit.
Do you think that we'll see a greater risk appetite amongst investors as we move deeper into this year, at least relative to what we saw last year, where everybody really did kind of embrace fixed income, embrace short-term treasuries, embrace cash?
Yeah, so $6 trillion on the sidelines. It's still paying a pretty good return for you to put your money in a money market fund. But I think that as we get through the next quarter or two, that investors who've been putting money in cash and the rates have come down a little bit, they're going to say, 5%, it's a no-brainer, 4%, 3%, maybe there are better places for my cash.
Are you starting to get the sense that people are willing to move that money along? Have you just, when you talk to your clients, are they talking in that way?
So our clients are long-term investors, so they're in a different position. But when, go home for the weekend or visit with family, they're saying, I can get 4.83% on a money market fund. And I'm like, well, you can get double that in stocks.
Yeah, so they're still staring at their APY and saying yes. I got to ask you about IT, because you say you like consumer discretionary, you say you like healthcare. You also say you like value technology. What constitutes value technology at this point?
So for us, it's when some of their valuation factors are trading less than the overall market. So one of our largest tech positions, and we would call a value technology company, it's Broadcom. And it has a dividend yield that's greater than the market, so that's a great thing. Plus, they did this recent acquisition with VMware. So this is going to boost their cash flow, operating margins, and earnings growth. So that would be a good value name for us.
Is it easier now? I mean, when we talk about sort of, I guess, bottom-up investing and bottom-up research, is it easier now to get a better read as to the health of these companies, and more importantly, better price discovery now that the market is, I guess, kind of settled a little bit relative to last year?
Yeah, I think this is a great time for value investors and bottom-up stock pickers, because it's really hard when it's only 7 companies moving everything. And for us, that actually created a little bit like the seashells that you find after the wave goes out. It did, even then, last year, created the opportunities that we think will prosper our clients going forward in 2024.
Okay, I like that analogy. That's very pleasant. Diane, always wonderful to talk to you. Diane Jaffe over at TCW, helping us count down to the closing bells here on this Tuesday afternoon. Stocks pretty much where they've been for a good portion of the session now, down about 0.5%, Scarlett, across the board. But of course, the price decline and the yield increase that we're seeing in Treasury markets right now, a big part of the story.
Yeah, a lot of red arrows when you look at Treasuries. And what's notable is if you hit WEI on the Bloomberg terminal, it's red across the board, whether you're looking at the EMEA region or Asia Pacific region, and certainly North America.
Yeah, it's a good point. This is a global sell-off. And did you see the numbers that came out of the Hang Seng Index and some of the main Chinese indices earlier today? All right, we're going to break all that down for you in just a second as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with our friends Carol Masser and Tim, the Angel Stenovic. Welcome to our audiences across all of our Bloomberg platforms.
Where's the halo?
Television, radio, originals, and YouTube.
We are
Carol
everywhere.
Masser.
We are everywhere. Based on that halo in the heavens as well, I guess, or
It's gone
something
away.
like that.
What'd you do to him?
The sunset.
Yeah.
You know, you didn't like it, so we got rid of it.
It was blinding.
It's you. Hey, listen, I heard you guys just talking NASDAQ, not NASDAQ, forgive me, but Hong Kong and China. We got some rough numbers again, kind of overnight. Concerns about whether or not China gets its story, but you're looking at the NASDAQ Golden Dragon China Index.
There you go.
Underperforming. My gift to you guys, down 2.6%.
Can I just say, we were talking about you earlier. I don't know if you actually watch our show, but
we're busy when your show
But we
is on.
actually
That's the sad
avoided
part.
talking about, we mentioned the K-Web, we mentioned FXI, we mentioned all the other indices, but we stayed away from that because that's Carol Masser's. They should just rename that index the Carol Masser Golden Dragon Index.
I think it's an important thing. I've been watching it my whole career in business news, and I still feel like, definitely.
It's been around that long?
All right.
We used to write on tablets and stones.
I was going to say,
So rough,
I was going to
man.
talk a little bit about the strong economic data.
I mean, you walked into that.
We got earlier today, Scarlett. And I was thinking, this isn't necessarily what the Fed wants to see, but I don't actually believe that. I think the Fed understands that this is the economy. I think it's investors who priced in 6 rate cuts this year don't want to see this strong economic data. The Federal Reserve, we learned from the most recent, rate cut expectations, the dot plot, 3 rate cuts. It's still this disconnect between what Fed officials at least thought a few months ago versus what the market is pricing
And they
in.
take pains to remind everyone that they're okay to, sit where they're at and wait and see to make sure that inflation is headed towards 2%.
All right, well, the clapping and cheering starts as is mandatory here as we get the closing bells in
Please
New York.
clap.
Red across the screen, yeah, absolutely here. I'm not sure what they're clapping for. Red across the screen for a second straight day. The Dow Jones Industrial Average down about 94 points or about 0.2%. The S&P 500 down about 27 points or about 0.6%. A similar percentage decline for the NASDAQ Composite. And your laggard once again here was the Russell 2000, which actually down for a fourth day, down 0.7%.
All right, so let's get to digging a little bit deeper into the S&P 500. Guys, clearly a risk-off trade on the equity side of things as we saw rates tick higher. 403 names to the downside, Scarlett. 99 actually gaining ground today, and we had 1 unchanged.
Yeah, and if you look at the sector breakdown, it's pretty clear what the bias is. It is to the downside. You have only 2 out of 24 groups finishing barely in the green. Insurers up by 0.2%. Healthcare, equipment and services up by 0.1%. Household and personal products unchanged. Your big laggards here are real estate investment trusts, autos and components, and utilities. Two of those three groups, of course, very rate sensitive.
All right, folks, let's get to some of the individual gainers. There's a couple names in the healthcare space that actually were outperforming today. Humana above it, the number 4 gainer in the S&P 500, finishing the day off its highs, but still eking out a 2% gain. Oppenheimer reiterating its outperform, maintaining a $630 a share price target. Stock closing just below $448 a share. Stock was down about 10% last year. Meantime, you had B of A removing it, along with Boeing, from the firm's US 1 list, which is intended, I'm reading in terms of what this means, intended to represent a collection of the best investment ideas that are drawn from the universe of buy-rated US listed stocks covered by B of A analysts. The firm did keep buy ratings on both, but I just thought it was interesting. But Humana, an outperformer. United Health, also an outperformer today, up more than 1%. Today defeated an appeal by a class of more than 200 doctors. What they were saying is that the insurer wrongly refused to pay them facility fees for office-based surgeries. Nonetheless, a win for United Health. Oppenheimer, too, out on this, reiterating its outperform rating and maintaining a $610 price target. Stock closed at $524 and change. What's up?
Can I add one to your list?
Please, but I'm not done. But go ahead.
Oh, sorry. Continue.
No. Go. This
maybe great minds think alike.
This is a group effort. I'm curious where you're going to take us.
Well, I was looking at Sinclair Broadcasting.
That is my third gainer, but go ahead.
So great minds do think alike.
Okay, or something. But 18% gain.
Maybe
but I
old
thought this was
minds
I thought this was
think
interesting. In all seriousness, we talk about Diamond Sports and basically a company that, for the most part, was looking to kind of wind down, if you will, and now a bit of a rescue here, coming out of bankruptcy with not only, of course, the debtors potentially agreeing to a program, but I thought more interesting, Amazon taking a minority stake in this.
There were a lot of moving parts to it. I will say that Benchmark came out and called this settlement the stock's biggest overhang. So, I mean, it was up, 18%? It is, a small cap, micro cap, if you will, but nonetheless, an outperformer in today's session. Anything else you want to say?
Did you get Maple Bear in there?
No, but I did get DWAC. So I'm going to take everybody there.
We're back to DWAC?
It's just interesting.
Is that how you
She
see
can't
it?
help herself.
I don't know. DWAC, I don't know. Digital World Acquisition Corp. It's the SPAC, right? They're trying to kind of in a hard way take over Trump's media and tech group for more than 2 years. They did jump, what was it? Oh, it was up 18%.
3% now.
No, 28% at its highs, just up about 3% by the end of the day. Investors kind of betting on maybe another Trump presidency, so maybe that would be a good thing with it. But I just thought it was an interesting story.
Okay, well, I got some interesting stories about the decliners that I chose
It was
for
an
the
embarrassment
day.
of riches for you, Tim. I mean, you had so many to choose from.
I know, but I only chose 3 because I follow directions. But I do want to talk about Apple. It was the worst performer on a points basis in the S&P 500. Interesting story around Apple today, of course, was that the company was, a judge ruled that the company had to stop selling its Series 9 and Ultra 2 smartwatches with the blood oxygen features in the U.S. Essentially, it's a ruling that means that Apple has to stop selling the watches with the oxygen measurement feature while an appeal of the ban plays out. So they're appealing this, but Apple thinks that could last a year or more. Interestingly, shares were down about 0.7% when this news came out, and they moved higher. So, I'm not saying that the stock moved as a result of this, just worth checking in on shares of Apple when this news hit. Charles Schwab shares fell as much as 7% when the company came out with its most recent quarter today, but down 1.4% on the day, 1.3% on the day. Schwab last year was swept up in the regional banking crisis as interest rate hikes eroded the value of its investments. Check out this quote from the company's CEO. Said that it was the most challenging year in my time at Schwab, certainly the most challenging since the bursting of the internet bubble in the year 2000. Schwab said that it reported declines in profit, new assets, and deposits. And then worth checking in on shares of Spirit Airlines after yesterday's decline of around 50%, close to 50%. Spirit Airlines falling again today, down more than 22% after yesterday's decline. This, of course, after a federal judge yesterday blocked the JetBlue Spirit deal. JetBlue shares were down about 9% today. We saw budget and regional carriers fall too. Frontier, Sun Country, Allegiant, Mesa Air Group all falling after they were kind of swept up in this deal not working out for these two companies.
Let's check in real quickly with what happened in the yield space. Most of the activity was on the shorter end of the curve here, 13 basis points higher on your 2-year yield. You got to go back to at least June or July of last year to find a one-day move like that on the 2-year yield. The rest of the curve did move higher, but you see the lopsidedness of it. A 10-year yield up about 4 basis points, your 30-year yield only up about 2. And that is the Fed repricing there. Of course, that 2-year yield most sensitive to any changes in monetary policy. And maybe they are finally starting to rethink, investors are finally starting to rethink those 5, 6, 7 rate cuts that they had priced into this market for 2024, dialing that back just a little bit, and more importantly, pushing out the start of it by a bit as well.
Did you guys notice that the VIX is now at 14.8? It's at a 2-month high.
Yeah, it was trading up
Slowly,
above
quietly,
15 for a good portion of the day.
Has made its way higher.
Remember when it was like, didn't it hit 40 like way back when?
Yeah, it does that every now and then, Carol.
It does, everyone. I always wonder, how do you guys read the volatility index? I mean, how do you think about it, those moves?
Well, I mean, I think it's significant. I don't know if the VIX is as a reflection of the stock market volatility as it used to be here. But if you overlay that with what you can see in the options market, you definitely see that the volatility is elevated, or the expectations of volatility, I should say, are elevated.
Yeah.
Well, speaking of volatility, for all the moves that we've seen in the equity market, in the first couple of weeks of the year, net, we're only down 0.6% on the S&P 500 from the start of the year. A little perspective.
If you're a small cap, though, you're down 5.6%.
Yeah, this is. I do wonder if, as we get deeper in the year, whether we are going to be kind of talking about a tale of two cities when it comes to the market. Again, not necessarily saying we're going to go back to that Magnificent Seven dominating everything, but there's clearly been a little bit of a splinter here over the last few days.
Yeah, remember the January effect? I mean, they definitely got front run in December because that market breadth expanding at the end of December when people realized that there was more to the world than the Magnificent Seven. That has faded now. And I think a lot of people are waiting for earnings season to see if, the numbers justify what they've seen.
Yeah, the other thing is we talked with Steve Matthews and Michael McKenzie of Bloomberg. And what was interesting is they reminded us, we've got, a Fed meeting January 31st. We're going to go into, a blackout week next week. You've got PCE next Friday. We've seen that trending lower. Do we continue to see that? That could be, as we go from data point to data point, that's going to be a big one.
But we only care about March's meeting, right?
Yeah.
Is that right?
Well, I mean, nothing's priced in for January.
Yeah.
I don't know why Tim is
care what Powell
denigrating
says
the
in
January meeting, which is just as important. Remember, Tim, every meeting's alive.
Every meeting is important. You're right.
Every meeting's a live one.
Except for January.
Except for January. All right, that's a wrap. All right, our cross-platform coverage, wrapping up the markets here on this Wednesday. Radio, TV, YouTube, Bloomberg Originals. Folks, we will see you all tomorrow.
All right, a lot more coming up here on Bloomberg Television. We're going to talk about credit card spending ahead of those results out of Discover and on the back, of course, of those retail sales numbers that we got this morning. Stick around. This is The Close on Bloomberg. A strong retail sales report here in the U.S. had the effect of pushing Treasury yields significantly higher on the short end. It pushed the dollar higher, and it led to an increase in volatility. The net effect of it all was price action to the downside in the equity space, and S&P 500 lower by about 0.6% here on the day. And watch out below. A lot of those key technical levels, the next pivot points now really starting to be tested. You take a look at your 2-year yield, the most rate sensitive of the major benchmark yields, up 13 basis points here on the day. And as we were talking about a little bit earlier, the sell-off we had in the U.S., it was a global sell-off. You saw that in Europe, and of course you saw that in China. The Hang Seng Index down about 4% in the last session. Meanwhile, Bitcoin gaining no traction here on the day. The KBW Bank Index also moving to the backside. That was on the back of some reports that we got out of Citizens as well as U.S. Bancorp as the regional banking season now really kicking off. And what we've learned so far, not necessarily good. Managed care, and in fact, a lot of the healthcare names were really the only real bright spot that you saw out there, at least as a group. And we are awaiting some earnings here after the bell, including from Alcoa and Discover. But let's focus on the housing market for just a bit here. We are getting some housing data tomorrow here, housing starts as well as building permits. And believe it or not, despite some of the concerns we've had about that increase in mortgage rates and the whole and the drop in affordability for a lot of these houses out there, home builders, new home builders, have actually done pretty well here, holding their own against the broader market, and more importantly, outpacing some of the doldrums that we've seen in the actual economic data. Scarlett?
All right. Romaine. And of course, we're looking ahead too, as well, to which sectors led the declines. You had real estate investment trusts falling. And that brings us to the Blackstone Real Estate Trust for wealthy investors. It actually posted its lowest annual return since making its debut in 2017. And at blame, higher rates and a slow commercial real estate market. Let's bring in Bloomberg's John Gittleson in Los Angeles for more on this. So, John, we pay attention to this for so many reasons, but what's notable here that I saw was that BREIT's gains fell short of the threshold that would allow Blackstone to partake in profit. So they're not able to make money off of this in a way.
Yeah, I mean, they're not able to make as much money as they'd like to make. Because of the carry. There's still basic fees that they charge to investors, but usually where they make their real money is they return, if they returns are greater than 5%, then they get a harvest 12.5% of those returns, which is, you know, a big share that they just missed out on. So it wasn't a very good year for the people who depend on that fund for getting an extra kick in their revenue and their income.
This gets to the point. I mean, I know that the folks over behind this have basically kind of talked down some of these redemptions, saying that nothing to be concerned about here. But there's a reason why people are looking to pull some of their money out as quickly as they can here. There's still a big unresolved issue here. And I'm wondering if there's been any sort of sense that that's being addressed addressed at all.
Well, the company has marked down the actual value of some of their real estate, but basically these kind of funds that limit redemptions, they are much more slow-acting, slow-moving than the publicly traded REITs. And there's a big gap between the valuations that are in the publicly traded REITs, which have been driven down very far, and what are in these so-called NAV REITs or non-traded REITs. The NAV REITs have been slower to adjust their valuations. So investors are going, I should pull my money out now while their valuations are higher and I can get my money back, put it somewhere else that's going to go up. But generally, real estate has been challenged because of rising rates. And, you know, just the math changes when your interest rate goes up by 5 percentage points.
Yeah. So big picture, what story do the returns of BREIT tell about the commercial real estate market at large? And how does this position Blackstone going forward?
Well, hopefully they've taken their pain this year. It seems like if interest rates have kind of peaked, then their returns will normalize. They say they have good asset classes in high demand. Data centers, which are growing like mad because of AI, student housing, where you have wealthy parents who are paying their kids rent there, and warehouses, which are still doing pretty well because of e-commerce, although that's weakening a little bit too. They got a lot of apartments, which again is also facing potentially falling rents. Yeah. So it's been a tough time for commercial real estate generally. They do not have a lot of office. And that's been the area that's been hit worst and has the worst outlook.
Yeah, absolutely. Here, John, always great to talk to you. John Gittleson over there in Los Angeles. We want to stick on real estate right now and pivot a little bit more to what's going on the residential side. Nora Melinda joining us right now, Bloomberg News reporter, to discuss an interesting trend here. And that's really just kind of the disconnect, Nora, between the cost to buy a house and the cost to, I guess, remain a renter. I mean, the narrative always, at least when I was younger, was always you buy a house as soon as you can because basically it's a better value proposition, certainly over the long term here. But at least just to get in the door, that gap, that financial gap between what it costs to remain a renter and what it costs to buy a home, that's huge.
Right. City analysts are actually saying that the average first-time home buyer is now 35 years old versus maybe 30 years old back in 2008. So we really are seeing that shift, especially as interest rates are at decades high levels, and nobody's really interested in taking on an expensive mortgage rate. Of course, when you have people who are locked in at 2.5, and people are saying that, a lot of experts are saying that that key number could be 5%, and who knows how quickly we'll get there considering we're at 6.7% today.
Yeah.
But it's a really interesting dynamic right now as people are dealing with this challenging macro environment.
Do you know how you know somebody has a 2.5% mortgage rate?
How do you know?
They'll tell you. Don't worry.
That's true.
This is true, by the way. Yeah, I think of all the people who kind of brag about it all the time at cocktail parties. So give us a sense. That number, by the way, is fascinating. The average age for a first home buyer would be 35 years old. Which demographic has been purchasing homes? Because it's not like home buying has completely disappeared. It's just slowed down a lot.
Of course. And it's really been Gen X and millennials that have been getting out there. I know people didn't know that millennials have been buying houses, but they have been taking on mortgage rates and getting their first homes. So that has really propelled the majority of that dynamic. You're not really seeing that, of course, for Gen Z. For people like myself, it might take a little bit longer.
I guess this is a question, too. I mean, some of these people are buying home because they have to, right? You get to a certain age, you've got a spouse, you maybe have children. I mean, at some point, you just can't stay in a small apartment. But it also gets to the question, too, about some of the older housing stock, meaning the baby boomers and other folks who are either at retirement age or getting very close to it here. What happens to that housing stock? Is that expected to actually sort of come back onto the market anytime soon?
I mean, Citi REIT analysts are saying that they are preferring single family rentals over multifamily apartment, family housing. So that's really interesting. So as you are thinking about these baby boomers or people who may be interested in getting their first time homes, they're actually looking towards single family housing in 2024.
All right, Nora Melinda helps cover the real estate sector for us, and we're going to go back and revisit real estate a little bit later in the program. But we do have some breaking news right now. Earnings crossing the wire on Discover. Those shares moving lower here in after-hours trading. The fourth quarter numbers for credit losses did come in higher than expected. $1.9 billion provision for credit losses in the fourth quarter. The street was looking for 1.63. That might be a big part of the reason why you're seeing the shares move lower. We should point out, though, that total deposits did increase. They're up to about 109 billion, and that beats street estimates. Net interest income also came in as a beat at 3.47 billion. Cash and investments coming in at 25 billion. And we should point out that loans overall, a slight beat there at 128.4 billion. The street was looking on average for 127.9, Scarlett.
Yeah, the stock moving slightly higher in after-hours trade, up by 0.4%. We also have earnings out of Alcoa, the aluminum maker. Traditionally, in the past, its earnings signaled the start of earnings season. No longer, because the big banks have moved ahead of it. The stock moving up by 0.9% right now, pairing some of its advances. Fourth quarter sales, $2.6 billion, pretty much in line with what analysts were looking for, which was $2.61 billion. When it comes to the bottom line, an adjusted loss per share of 56 cents. That is narrower than what analysts were looking for. They had anticipated a deficit of 84 cents. EBITDA for the fourth quarter on an adjusted basis was $89 million. That was lower than what analysts had been looking for. They anticipated $110 million. We'll continue to keep an eye on earnings, including any others that cross in the next couple of minutes. This is The Close on Bloomberg.
All right, welcome back. Before the break, we were talking about the commercial real estate market, and we want to continue that conversation right now with someone who knows a great deal about it. Lauren Hochfelder joining us is co-CEO of Morgan Stanley Real Estate Investing. And we talk about some of the trends, Lauren, that we've seen in the commercial real estate market. And I felt like most of those trends had more to do with fear and speculation rather than actual fundamentals.
Yeah.
I'm curious as to whether we've sort of gotten past that, whether we can sort of take a closer look at what's really going on in commercial real estate and have investors, for that matter, and the researchers actually make, I guess, more coherent assessments of what's really happening.
Right. Well, the good news is 2 years in, I think there are finally specific conditions that will bring buyers and sellers back into the waters. And some of those waters are smooth sailing and some of them are really choppy. So we've talked about, massive wall of debt maturities and no lenders there to refinance it, et cetera. We're starting to see fundamentals normalize, let's say, as global economies decelerate. So lots of areas for choppiness, but there are some really smooth areas.
Every time I talk to real estate developers, the people who are really building this stuff, they're always quick to point out just how long-term their projects are. That they're not making decisions based on, what the Fed rates are today.
Yeah.
They're really looking 10, 20 years down the road to make those decisions. Those are structural issues.
Yes.
What are sort of the big structural themes that you're looking at that you think would entice whether it's developers or investors, back into this market?
Yeah, well, a big one that we're getting reminded of maybe more frequently than we like today is the complete overhaul of the global supply chain. So, the global supply chain, it's only as strong as its weakest link, and we see daily. Today, it's Houthi rebels attacking civilian container ships in the Red Sea, affecting global trade. COVID supply shocks, our sneakers got stuck either because Chinese factories were closed or they were stuck out in the port of LA. Panama Canal, climate issues, all of these factors affect the global supply chain. And what we're seeing tons of capital poured into, both public money and private, is nearshoring, reshoring, friendshoring. All of these things create more aggregate demand, and they change where that demand is and for what type of product.
So those warehouses that are being built to fulfill those needs, how far along the continuum are we? Are we in the early innings, like second inning, third inning? Are we in the fifth inning?
Yeah. So look, the past decade has been all about e-commerce growth, and that's a trend that we identified and invested behind early. I think there's still room to run there, but this new trend, this trend of the overhaul of the global supply chain, I think it's early. Global supply chain rebuilds, that could take decades, and so we're seeing construction along the Mexican border. We're seeing a shifting of 5-point entry points into the U.S. Lots of change.
Where else? You mentioned along the Mexican border, but what are the other 4 points? I mean, I'm just trying to get a sense, because it's all geographic when it comes down to it.
So absolutely. I think, look, firstly, the West Coast ports of the U.S. were always the strongest, right? That's where goods came in from China. As we migrate where we manufacture from China to India, those goods are coming in from the East Coast ports. So that's making those ports more important. And then you see some duplication in terms of the various markets.
Can we pivot from that and just talk a little bit about just the aging of our population and what that means in terms of real estate investment opportunities?
Absolutely. I think it's two things. One, as people age, they're spending more on healthcare, and that increases the need for healthcare-oriented real estate, medical office, life sciences, et cetera. But I think maybe the more interesting thing is how it affects housing. So we love the long-term trends around housing. There's simply too little of it on a global basis. But there are certain markets where there is too much supply, too much debt, too much expense growth, and too little rent growth. But most importantly, to your point, as millennials are growing up and growing out, and boomers are growing older, there's too much supply of the product of the housing that they lived in yesterday, and too little of the product that they want to live in tomorrow.
Okay, so that's good if you're an investor. I mean, if you want to chase that, that's good for an investor.
I think it's tough for those markets, those micro, multi-markets in, some of these Nashville, Raleigh, they're seeing 15% of their existing stock under supply. That's tough, but for more single family.
Lauren, really appreciate your time. That's all we have time for. Lauren is co-CEO of Morgan Stanley Real Estate Investing, and Lauren Hochfelder, thank you so much. All right, we're going to talk retail sales next and credit card debt. This is The Close on Bloomberg.
All right, it was economic data this morning that drove a big move higher in Treasury yields, and that big move higher in Treasury yields led to big moves lower when it comes to U.S. equity prices. 0.6% on the S&P 500, more about 1% lower here for the Russell 2000. And you take a look here at the benchmark 10-year yield, only up about 5 basis points. Most of the activity was on the shorter end of the curve, with the 2-year yield up by about 14 basis points on the day. We've been talking a lot about the uptick in volatility. We had already seen that in the MOVE index, which had been surging over the last couple of days, and now the VIX, which tracks volatility expectations for the S&P 500, also moving higher here. At one point, it was trading up around 15.5. Now settling back below 15, but still well elevated, Scarlett, from where it had been. In fact, the average particularly over the last 6 months, had actually been down around 11.
Yeah, very subdued. And of course, we'll continue to monitor how the VIX performs. What the big catalyst for today's downdraft in equities was, of course, the hotter than expected retail sales report. December retail sales in the U.S. rose at the strongest pace in 3 months, really capping off a solid holiday season and signaling a resilient consumer heading into 2024. Let's bring in now Bloomberg Washington Bureau Chief Peggy Collins, who's covered economics for us. Peggy, this report capped off a 2023 that defied a lot of economists' expectations that we'd get a recession. That did not happen. However, there is a sense that perhaps there is going to be a slowdown in 2024. We just don't know the extent of that slowdown when it comes to consumer demand.
That's right. And as you said, Scarlett, the retail sales numbers that came in today are another example of how resilient the consumer has been. As you said, there were some concerns even going into the holiday season about whether or not some of the strains on the economy that we've seen with higher prices and inflation would finally show up in the retail sales data over the holiday season. But no, it didn't. It's still very strong out there when it comes to the consumer. And that's offsetting some of the weaker manufacturing data that we're seeing in terms of where people think the economy will go. And of course, that's the question the markets are saying to the Fed, is whether or not this resilient consumer will give them more reason to hold off cutting in 2024, or at least the beginning of it.
And that resilient consumer, the question not only just about holding off, but does that actually sort of goose inflation in a way that maybe the Fed has to start thinking about the opposite direction that the market wants it to go?
I think right now the Fed is most focused on that soft landing, not doing anything that gets in the way of the economy coming down at a pace that, that we don't have a lot of people lose their jobs, quite frankly. So that's what we're going to be watching ahead here as we report, is what does the Fed think in terms of the risk to cutting, in terms of maybe potentially having to reverse and hike again, which they don't want to do, as you were saying, Romaine.
Yeah, and of course, we talk about this theme of consumer resilience that's apparent in the retail sales report and really across many parts of the economy. You were just in Iowa attending the Iowa caucuses. Do you see that consumer resilience, that sense of things are going to be okay, reflected in what you experienced there?
So, Scarlett, it was incredibly cold in Iowa. So I will say that there weren't too many people on the streets or in the stores because of the below zero and in some cases negative 20 degrees. What we did hear from voters, though, was that in the inflation and the economy were top of mind, that they are seeing the high prices. They're concerned about their wages keeping up with them and the day-to-day expenses that they've seen go up. That was riding right alongside border security issues in terms of the top things that we heard from people in Iowa when we talked to them at caucus sites and around Des Moines, Iowa, where we were at the time.
All right, Peggy Collins, let's shepherd all of our coverage coming out of Washington, D.C. A closer look here at some of the economic data, a closer look at the resiliency of the U.S. consumer. And while that consumer is remaining strong, they seem to be putting a lot more of that strength on their credit cards. Total balances in the U.S. have soared to all-time highs, but is that necessarily a bad thing? Joining us right now to discuss is Mike Dixon, head of research over at Horizon Investments. And let's get right to it, Mike. A lot of hay being made right now over the elevated level of credit card debt. But I guess I'll pose the question to you very simply here. What does servicing that debt look like right now when it comes to the health of households?
Yeah, certainly a good point, and thanks for having me. When it comes to credit card debt, there's a couple things that I think are really important. One, starting place really matters. And as you mentioned as well, the ability to service that debt really matters. And we look at the level of overall credit card debt. It was high back in the Fed's September report. We're going to get a new report in a few weeks, highest level that we've seen. But when you normalize that for earnings and normalize that for overall net worth, it's barely a blip on the radar. Mm-hmm. And I think that's really important. Second thing,
go ahead. Yeah, I'm sorry. Go ahead. I was going to ask you about delinquency rates just to tie into that. So, I mean, you have elevated levels. Maybe you have household income and household savings enough to service that here. We have seen an uptick in delinquencies here. Has that not given you any concern yet?
Yeah, again, just go back to starting place. So we have seen a small uptick, of around going from about 60 basis points or so for 30-year delinquencies and about 1.5% for 90 days. But both of these numbers are well below pre-COVID averages. So you're really coming off of really all-time lows on those delinquencies. And that in and of itself certainly does not spark any concerns at the moment. This is certainly data we need to keep an eye on. But just coming up off of these lows does not concern us here at the moment. I think there's some greater concerns other than credit card debt, in the market right now, because realistically, that's a very good, strong sign of a healthy economy with consumer spending. And we saw that this morning with retail sales. And the Atlanta Fed, GDP Now forecast, bumped up to 2.4% as a result of those prints this morning, which is very healthy.
So I'm curious in terms of what you might have heard from the banks when they reported, the anecdotal that goes along with the numbers that you're crunching and you're synthesizing. What did you hear from them that maybe gives you pause and has you looking a little bit more closely at parts of the consumer credit card story?
Yeah, overall, the consumer has been very healthy. I think it's something to look at is kind of where any of the weakness is in the credit card data. There's definitely been some reports of kind of weakness in the areas, age, for example, that might have the least amount of savings. They would be the most susceptible to having issues with servicing that debt. But at the same time, when you look at the wage story, you've also seen real wages increase for the younger population as well. And again, those folks are going to be the ones that don't have a lot of that savings and cushion to help service that debt. So I think we're really in a flux period right now as you have overall real earnings into positive territory. And that'll be really important to kind of replenish some of the savings that have been depleted. And I think that balance of replenishing savings could help keep inflation subdued, even with an increase in real wages to offset the credit card balances.
Yeah, we have a chart showing U.S. millennials and Gen Z under pressure. We know a lot of members of Gen Z don't necessarily like using credit cards. They prefer to go with buy now, pay later. Do we have any sense of the troubled loans in the buy now, pay later space? How might we start comparing that to what we're seeing in the credit card space?
Yeah, when you look at the entire kind of credit picture, outside of credit card debt, let's look at, other things like mortgages and auto loans and other revolving and non-revolving types of credit. Again, kind of normalized for the overall level of total household assets and earnings. Things look fine right now. Again, we're off of very, very low levels, but we're still below averages prior to COVID. And so just as a lot of course, the inflation shocks and the changes in interest rates are working their way through the system, I certainly expect some of this normalization. And again, we're going to get some new quarterly data from the Fed here in just a couple weeks on every way you can slice and dice the credit situation. And that'll be really informative because a lot of these data points we're talking about currently are a little dated. This is only quarterly data, and it does get released with a lag. So we're really anxious to take a look under the hood here at the start of February for that new data.
For investors out there that are really trying to get a sense here of these elevated debt levels and whether they should be concerned about it, what's kind of the metric that you look at that maybe will provide a little bit more clarity? Are you looking at things like just job growth or wage growth? I mean, is there something that gives us a little bit more of a tell as to whether we're making too much out of this?
I think you got to look at the whole picture of how to service that debt. So personal savings rates and savings levels in general are very important to look at. The wage growth story specifically, and in particular, real wage growth is also very important, and how that might, actually, replenish some of the depleted savings. Those are very important metrics. Of course, more frequent, labor market data that we do get that could have, impacts to the wage side, down the road is a very important leading indicator as well. But overall, those data points have been quite constructive and certainly point to a very strong consumer that has the ability to service the debt. And some of the headlines that we read about high levels are just coming off of a very low base. And I think we do need to keep that into perspective because we do want a growing, healthy economy. And with that is going to come just higher nominal gross values of things like credit card debt. And so it's important to normalize that for other data points that help service the debt.
Well said. Mike, really appreciate your joining us. Mike Dixon of Horizon Investments on the credit card debt picture in the U.S. Coming up, a number of regional banks came out today with their earnings. We're going to dive deeper into their results next and what it tells us about the state of the economy. This is The Close.
I'm very concerned about the regional banks. I'm not concerned about the large banks, the SIFIs. I'm very much concerned about the small and mid-sized banks. They've got several risks happening at this point in time. They've got commercial real estate and a refinancing wall in that space and a refinancing wall in their commercial and industrial loans. And I think that this is going to cause them to have to, really take risk considerations very carefully. And I think the lending capabilities that they're going to have and the capacity that they're going to have to lend is going to be very limited.
That was Ann Walsh, the Guggenheim Partners Investment Management CIO. She was speaking with us earlier at the World Economic Forum in Davos. And of course, she mentioned regional banks. We know they've started to report results. More are coming out tomorrow. So here to give us kind of a wrap up of what we've heard so far and what we can expect is Herman Chan. He is Bloomberg Intelligence Senior U.S. Regional Banks Analyst. Ann Walsh is pretty bearish. She's very concerned. What did you hear from the regional banks that have reported so far that would back up that concern?
Sure. So the general theme is that higher interest rates will continue to pressure net interest income in the banks for maybe a couple more quarters until the Fed starts cutting interest rates. In the meantime, loan growth has been pretty dismal across the industry. You're not seeing a lot of commercial loan growth, and any growth you're seeing is in credit cards, as the previous segment alluded to. The good thing is that banks are starting to be more optimistic on loan growth. They're seeing stronger pipelines. They're seeing potentially better activity as everybody seems to anticipate lower interest rates going forward.
So that's driven by lower interest rate, the loan demand, not anything else. So if rates stay where they are, do we anticipate that loan demand will come to fruition?
Yeah, that's going to be a mixed story, I think. Really, everything will be predicated on interest rates. In the meantime, the net interest margin has scope to really trough over the next couple quarters and then increase as those fixed rate assets on banks' balance sheets reprice higher.
Have those deposits come back that they lost?
Yeah, deposits have largely stabilized after that March.
Well, stabilize or come back to normal?
Stabilize.
Okay.
So things are still flat. So they're not really driving higher deposit growth because there's not a lot of loan demand. That's really driving.
I mean, what's the future of these banks? There's been so much discussion about the potential new capital rules. There's been a lot of discussion about what the role of these banks should be in the first place. I mean, if you believe Elizabeth Warren, they shouldn't be doing anything other than just taking deposits and giving you toasters. I don't know if that's the future, but when you consider how much business has been lost to the bigger banks relative to the regional banks and from the bigger banks into private capital, there's a lot of questions as to what the banking system looks like and whether we need all of these banks.
Yeah, that's really a good question for the regional bank CEOs going forward. And PNC CEO actually mentioned and talked about that pretty extensively on their earnings call the other day and said the industry is ripe for consolidation. You've seen a lot of business ceded over to the big banks, and the regional banks need to be bigger in order to compete.
On the loan side, and particularly when it comes to business loans, small business loans, is that still, are regional banks still the primary place where folks are going, or is that shifted?
Yeah, that's the bread and butter for regional banks. Unfortunately, we're in this high rate environment where there's not a lot of demand.
So consolidation is something that people have been calling for since the regional banking crisis last March. Janet Yellen, the Treasury Secretary, talked about this. What's going to be the catalyst for that to happen? Is it going to be another near, I don't want to say failure, but another bank wobbling to get that going?
Yeah, there's a couple of issues that are impeding bank M&A. Number one, it's the higher rate environment where when you do a deal, you have to mark to market the balance sheet. And when you do that in this current rate environment, it does create a bit of a hole in the buyer's balance sheet. So it's not conducive to transactions at this point. And again, lower rates would help that. Number two is the Biden administration has been a bit reticent to approve mergers, and they've taken a longer time to approve those mergers that happened a couple years back. And so bank management teams are pretty wary of that uncertainty.
I have a question. This is kind of a little bit more of an esoteric question, but it really goes back to the crisis in March or whenever that kicked off last year. Do we sort of make too much of that? Because at the time, it seemed like the sky was falling. Everyone was worrying about the systemic risk. That obviously didn't materialize yet, although there's still some people saying just wait. Is there something to wait for, or are we just kind of past that?
There's headline risk in areas like office commercial real estate, but I would point to the banks have already prepared for any potential weakness. We're talking about already a 10% reserve on office commercial real estate loans. So any sort of deterioration is going to be fairly manageable for the group.
All right, Herman, always great to catch up with you. Herman Chan, who leads our regional bank coverage over at Bloomberg Intelligence. Breakdown here of some of the earnings that we've gotten and some of the earnings up ahead. We do want to stick on the banking sector and go back to one of the big ones over in Europe. UBS Chairman Colm Kelleher says regulators are pushing to increase capital at banks are looking in the wrong place to address weaknesses in the financial system. He sat down with the very own Stephanie Flanders at the Bloomberg House in Davos, Switzerland. Take a listen.
The integration is going very well. I was very lucky, we as a board and the shareholders were very lucky to get Sergio Amotti back, who knew the bank inside out, had already downsized in the relevant areas. And this is a massive integration. As I said, it's the first time ever two G-SIFIs, or G-SIBs as they're now called, were put together. The market likes what we're doing so far. The relatively easy bit was done first, which was the initial downsizing. But to put it in context, Stephanie, as you know, Credit Suisse had 1,100 legal subsidiaries. It's a very messy, convoluted organizational structure. And as anybody who's done integration knows, that's the bit you need to tackle to get the costs out. So I think 2024 is going to be a very hard year of heavy lifting to, as we've publicly said, merge the parent banks by June, merge the significant subsidiaries by June, and then we can start really attacking those allocated and stock costs.
So you mentioned June. Is that going to be a sort of key milestone that shareholders and others should be looking at? Or when will you say, actually, we have now done the hard work?
Well, I think we've done the hard work and the exit of 2026 when we've given our exit rate and our cost-income ratio goals and the full costs that we'll take out. But I think as we get through 2024, organizationally, we'll be in a much better position, and then we can really start tackling a lot of stock costs.
There was a lot of talk at the start of people trying to get to grips with the extent of the outflows from Credit Suisse, how they were being dealt with. So are you confident that that is all behind you now that you've resolved?
I think so. We showed in Q3 and we will show that those outflows slowed down and in fact reversed. We actually have had net new money both in the deposit channels as well as the wealth management channels. So we're confident that we're rebuilding that now. The degree to which we can make up all of that loss, we don't know. I mean, obviously, clients had other alternatives. There was some funds went to the Swiss cantonal banks. Some of the foreign banks, particularly in Asia, gathered some of those monies from Credit Suisse. But we feel pretty optimistic now that people feel very comfortable with UBS as a brand.
And I mean, one of the questions that people had, having seen, and obviously there have been problems with Credit Suisse building up, there have been a risk, a tolerance for risk or a risk appetite that was certainly different from UBS. How are you finding it as you onboard the Credit Suisse clients, that adjustment of risk appetite? How is it working?
Well, I think Credit Suisse had 4 different businesses, so you have to specify where the issues were. And I've been very public about the issues at Credit Suisse were in the investment bank, by and large. That's where we had the cultural issues. That's where the losses had been made. That's where I felt there had been bad behavior. What we've now got with the integration is Credit Suisse people who come into UBS feel very comfortable with UBS. It is a one-firm firm. I think Sergio has done a good job of welcoming people. I was pretty outspoken at the time about the cultural risks, and I do believe that culture is a defining challenge for any institution. But on the whole, we've been pleasantly surprised by what we've got. The Swiss bank is very similar to UBS, so that's kind of plug and play from a cultural point of view.
Colm Kelleher, UBS chairman, speaking a little bit earlier at the Bloomberg House out in Davos, Switzerland. Stick with us here on The Close. We need to take a break, but when we come back, we're going to set you up for what investors have their eye on over the next 24 hours. This is Bloomberg. All right, wrapping up a relatively busy day here in markets. Here's what they'll have their eye on over the next 24 hours. We're going to go back out to Davos, Switzerland, where a lot of great interviews are on tap.
Yeah, a lot of CEOs of finance companies and big banks. We've got Blackstone CEO Steve Schwarzman, Bank of America CEO Brian Moynihan, and of course the new CEO of Morgan Stanley, Ted Pick, and the CEO of Barclays as well.
Yeah, absolutely there. And you see Brian Moynihan also going to be making an appearance at 11:30 a.m. on New York time. Also going to hear from Fed President Raphael Bostic, the other Bostic. We haven't had a whole lot of Fed speak. I mean, I feel like it's been a little lighter than what it normally is.
I'm kind of surprised, too, given that you have a Fed meeting next week, and this is kind of the last chance to get it in before that blackout period begins. But he is speaking twice to make up for the lack of Fed speakers.
Of course. I'm sure there'll be totally different speeches. By the way, we also get some economic data, including those weekly jobless claims.
Yep, jobless claims, of course, a high-frequency data point to look at the strength of the labor market. We also get the Philly Fed business survey, as well as housing starts for a picture on the housing market.
And the earnings season continues. We get quite a few. The one I'm really keeping my eye on, TSMC, they're going to report overnight.
Yep.
Remember, this is obviously the biggest chip foundry, but we can learn a lot here about the health of the electronics industry.
Especially since the tech sector hasn't begun reporting it. This will help set the tone for chip companies.
Truist, KeyCorp, JB Hunt also reporting. We'll have a full breakdown of all those earnings tomorrow. Please join me and Scarlett tomorrow, right here on Bloomberg.